And the likes of Goldman Sachs or Brian Belsky at BMO or other analysts have come out and upgraded their forecast for stocks. Is that part of the story that they need to see come through?
In the long run, good news is just good news. Eric Robertson of Stanchart has said this over the weekend. We may have already seen the trough in the US economic data. That's what the market's priced for. That's what we need to see now. And I hope we see that in the ISM when we get it later this week.
Although, here's the rub, and this is a bit of an issue. This is all predicated on the Fed continuing to ease policy rates. If the Fed gets justification not to ease policy rates because of the reacceleration that's in the data now, does that stymie some of the bullish calls that really see a lift from some of the Fed accommodation?
I mean, possibly, of course, yes. If you look at small caps and they've rallied almost exclusively on the rate story, there'll be pockets of this market that won't like that. What would concern me is what's stopping the Federal Reserve. Is the Federal Reserve constrained by the inflation story or just happy with the growth story? If they're happy with the growth story, that's a good story for risk. It always is, over the long term. If they're constrained by the inflation story, we've entered a new regime. That's problematic. And a risk of seeing a repeat of what happened last time when they had to really take a step in and do something about inflation and sacrifice things in the labour market. I hope we don't get there. There's a lot of hope coming out of my mouth this morning. I hope that's not what we see.
Well, I think everyone pretty much agrees with you who's long this market because, as our next guest talks about, the one potential scenario that could stymie the rally and the incredible enthusiasm that we hear around every corner in Wall Street is a suddenly hawkish Federal Reserve exactly because of some sort of inflationary threat.
He's coming up next. Max Kettner of HSBC is going to join us as Wall Street looks to recover from last week's losses. Plus, Henrietta Trey's Aveda Partners as the government shutdown standoff deepens, and the PIMCO CEO, Matty Roman, on financing the AI infrastructure boom. We begin this hour with stocks inching higher as investors continue to navigate the AI boom. Max Kettner of HSBC saying things are looking up, writing the broad-based asset price inflation is continuing full throttle, and we think there's more to come. Max joins us now for more. Max, good morning.
Good morning.
We were talking about your note you published earlier this morning, so I think we should probably start there. So here's the line. We still see clear signs of US and global growth re-accelerating in contrast to downbeat consensus expectations. Lisa, straight away, bang. What's downbeat about consensus expectations into next year?
Look, I think when we look at both earnings expectations and top-down GDP expectations, they are still pretty downbeat. Certainly not where GDP now is, where all the high-frequency data are, both top-down and bottom-up. If you look at bottom-up, actually, when we strip out tech, earnings expectations Q3 versus Q2 are pretty much flat. So we're going into Q3 earnings season in a couple of weeks where, for most sectors, actually consensus is saying earnings are either going to be flat or down quarter over quarter sequentially. In a quarter where probably growth has been really, really robust from a top-down perspective. That doesn't make sense. If you look at Q4, even GDP, what we're seeing is it's barely 1% quarter-over-quarter annualized growth expected. Again, what we are not only seeing at the headline number, that 1%, which is a 0.25% annualized, but when we look at the contributions to that, consensus is still saying there won't be any comeback of investment. And that doesn't make sense to me. You can't say we've got a little bit less political uncertainty. We kind of know how to deal with this environment now. We've got the big, beautiful bill coming through. We've got wealth gains coming through. We've obviously got, these AI capex story coming through. But at the same time, consensus is saying, nope, all this tariff story, it's going to continue weighing on investment in particular. And that's really big upside surprise potential.
I think the reason why both John and I were a little bit confused by this idea of consensus is because In the past couple of days, Brian Belsky saying 7,000 for next year, not necessarily high enough. Christian Muller-Glissman over at Goldman Sachs upgrading their forecasts, and Goldman Sachs keeps upgrading to the markets repeatedly. John Stoltzfus, the biggest bull on Wall Street, you see others just coming out of the woodwork talking about 7,700 on the S&P for next year. How can you say that's a bearish outlook or not bullish enough?
Yeah, look, actually, what we are seeing now, that sort of streak of upgrades, that's the most bullish thing that you can imagine. Because we run a series called Consensus GDP Forecast Diffusion Index, where we actually look at the data that you guys produce, so all those consensus expectations around GDP. Once that shoots higher, so once you really see upgrades across the board for the major global economies, so for the likes of the US, Canada, China, Eurozone, and so on, that is really, really bullish. Right, particularly for cyclicality, particularly not only for adding for equities and not just, okay, it's a monetary-driven story, it's probably tech outperforming, but really for cyclicals to outperform. Now, on the other hand, let's not just focus on the expectations and on people upgrading their, the year ahead forecasts, but also about the market action. When we look at the market action year to date, and you look within the S&P, cyclicals are up pretty much the same as defensives. So it's not like cyclicals are up 20% and defensives are like 5%. And you're like, wow, this is all baked into price action already. No, both are up, give or take 9%. So it's not like actually price action is telling us, wow, there's so much hope into cyclicals baked in.
Not to be a negative Nelly, but you could argue, hold on a second, not always. I'm just contrarian Courtney. Look, honestly, we're looking forward and we're talking tonight. Please, bear with me. Honestly, you could say if things were looking so good, why is the Fed cutting rates?
That makes it even more bullish. If we're honest.
Right, sure, but why should they cut rates?
They shouldn't. I mean, don't ask a German why they should cut rates, right? The German will always say they shouldn't be cutting rates. No, I mean, look, I guess the point is to bring it back to slightly more, serious topics. If we look at what the Fed can do, can they cut another 1 or 2 times? Sure, fine. Should they necessarily, with uber loose and easy financial conditions? Probably not. With 3-ish inflation, should they really be cutting a lot? Probably not. But at the same time, what we undeniably have is we have weakness in the economy. It's very different. The economy is on 2 very different paths. Let's be honest. If we weren't market people, if we were people working in the Labour Department, we'd be talking about the economy very, very differently. There is absolute strains on the weaker part of the economy. We're talking about the Russell 2000, John. You were talking about the Russell 2000. Let's go one step down. Let's go to the smallest caps that aren't actually listed. There is very clear strain. They can't get funding. You look at credit card delinquencies, auto loan delinquencies. Look at real wage growth, the highest wage growth percentiles versus the lowest ones. The lowest ones are already going to around 0% real wage growth. Tariffs, of course, are eating into the lower-end consumer goods, into things like food and beverages that already have outstripped cumulatively inflation since COVID. Now you add on tariffs. It's a clear strain on the weaker part of the economy, and they need the rate cuts. What that, of course, for us means, it's even better for asset price inflation. And because you've got a re-accelerating economy, and now you throw on rate cuts, which normally never happens.
That story you described doesn't make you bearish. In fact, it makes you incrementally more bullish because they're going to have to respond to it. What would make you bearish is what Lisa is trying to ask here.
Yeah, I think, look, it is very clear. Anything around, let's say, Supreme Court or government shutdown, that's like, yeah, can we get like 1 or 2 or 3% down? Sure, right? A handful of percent down. But at the end of the day, this is just buy the dip opportunities. The reality is, if we get a return to 2022 where the Fed says, oh, shoot, we are very wrong. This is like 2022. This is transitory. If we say, oh, you know what? This is not just 3%. This is entrenched 3%. And 3% seems to be the low now. And now we're re-accelerating even inflation. We're not even done cutting. We're not even stopping. We're actually, the next move is a hike. Once we get that puts a stop to it. How far are we away from that? Minimum 2 quarters. Last week, I still had conversations about, oh, they're going to do 50 in October. We're minimum 2 quarters away from that because let's remember, we have had this re-acceleration in the data that, not a lot of people were talking about a month and a half, 2 months ago. Now it's sort of creeping into people really and saying, hey, look, yeah, the US seems to be doing better from an aggregate growth perspective, but what we really need for a proper hawkish shift is actually a re-acceleration in the labor market. And given that supply story, given that really low break-even number, it's almost impossible to get that in the next couple of months. Right? So that makes it sounds intuitively completely wrong, but it's the best of both worlds. You get a sort of weak-ish labor market, but you've got re-accelerating activity data, which means good earnings, but sort of sluggish consensus expectations, low bar to beat, but at the same time rate cuts into a re-acceleration. Which, Lisa, to your point, is that a policy mistake? I think so. But of course, you know, that's probably a story we're going to play in 2026, not the next 6 months.
Max, smart and good to see you. Thank you, sir. That's the bull case this morning from Max Kettner of HSBC and Contrarian Courtney. Coming along for the conversation.
I shouldn't have said that.
Letting that go. Where did that come from?
I don't know. It was just, you know, one of those things. Happy Monday. Look, you know, what Max is talking about is really important. It's this idea of not what the Fed should do, it's what they will do. I just wonder, are rate cuts the most efficient way of targeting the K-shaped economy? Is that the best way to help the lower income sphere of earners in the United States of America and frankly around the world? Or is that just inflating the asset bubble and creating an even bigger divide? And ultimately, is that going to be the policy mistake that we come back to?
I think Max is saying it's the latter and he's going along for the ride.
I think a lot of people are.
Basically. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Donald Trump said the government is likely to shut down unless Democrats back down from their demands. Senate Minority Leader Chuck Schumer says a stopgap has to include an extension of health care subsidies. The top 4 congressional leaders will meet with the president today at the White House, a day before funding is set to run out. Meanwhile, at least 4 people were killed and several others injured at a Michigan Latter-day Saints church on Sunday. A gunman rammed a truck into the building packed with worshipers, opened fire, and deliberately set the church ablaze. The suspect was killed after officers engaged in gunfire with him at the church parking lot. And New York City Mayor Eric Adams has ended his re-election bid. The announcement follows reports that Adams was entertaining potential job offers from the Trump administration and the private sector. That's in exchange for bowing out of the race to allow former New York Governor Andrew Cuomo to challenge Democratic nominee Zohran Mamdani. Carlos Sliwa is also still in the race. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, Finding Common Ground.
We want to find bipartisan common ground to find a spending agreement that avoids a government shutdown.
You don't hold the people hostage for their services to allow yourself political cover, and that's what Chuck Schumer and Hakeem Jeffries are doing right now.
Up next on the programme, Henrietta Trays of Veda Partners with Anne-Marie down in Washington, D.C., and a sprinkle of guess who? Contrarian Courtney for the next 2 hours.
Come on.
You think I'm forgetting that anytime soon? Contrarian Courtney, what on earth was that? What was that?
Well, it was just, you know, I'm not Negative Nelly. Then Contrarian,
Yeah,
what name would you put?
All right, yeah.
Courtney.
I wasn't coming up with names for you this morning.
Let's move on.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jemana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
A big week coming up, packed with economic data. We're hoping to get the payrolls report on Friday. If you don't get that, we'll get the private market indicators, the likes of ADP on Wednesday. Look out for the ISMs, the PMIs. That's where the focus is going to be for market participants.
Yeah, ultimately, you use what you get. If you ultimately have a Fed that is data dependent, well, what do you do if you don't get data? You look at other data, the tertiary data that's going to take on increased import, make ADP great again. That's going to be this week.
Then it's already been happening, hasn't it, over the past few months?
It has. It's been a disproportionate response. I just wonder how volatile markets will be in response to some of these data points that often are viewed as not consistent necessarily with the labor market report.
Particularly given the divide we've had over the Federal Reserve more recently. The scores so far this morning, pretty good. Up again following Friday's gains. Up this Monday by 0.5% on the S&P. On the NASDAQ, up by 0.6%. Under surveillance this morning, finding common ground.
We want to find bipartisan common ground to find a spending agreement that avoids a government shutdown and actually meets the needs of the American people in terms of their health, their safety, and their economic well-being.
It's fine to have partisan debates and squabbles, but you don't hold the people hostage for their services to allow yourself political cover, and that's what Chuck Schumer and Hakeem Jeffries are doing right now.
So here's the latest this morning. Congressional leadership from both sides of the aisle meeting with President Donald Trump today in an effort to avoid a government shutdown. Anne-Marie joins us now from Washington with a special guest. Hey, Anne-Marie.
Hey, John, good morning. Well, ahead of that meeting with the president, it doesn't seem like either side, Republicans or Democrats in Congress, are prepared to blink. And we're now joined by Henry Trace of Veda Partners, who has a 70% chance that the government will shut down tomorrow at midnight. Henrietta, my first question's got to be, why not is it not 100%, given the fact that House Republicans aren't even coming back to Washington?
Yeah, I speak with staff on the Hill all day long, and they have been at 90% for quite some time now. I guess my reticence is just that we are still many hours away from an actual shutdown. And when it gets to this high media tension, high intensity dynamic, you don't get a resolution until the 11th hour. There are a couple of ways to get off ramps here. My odds of 70% are very high for me, about on par with the poly market odds that we've gotten now since this meeting of the Big Five, I guess, was announced for later on today. So we'll see how it goes. There's just a long way off is basically my point and why I'm at 70% odds.
What off ramps are you looking at that could be a potential in the final hours?
I want a short-term stopgap. I want like 3, 5, 7 days, nothing major. The bottom line is that there is a lot of very serious red meat that you can throw at both sides. The farmers need a bailout, for example, as China stops buying soy from the United States. The Democrats want ACA subsidies. That's a huge boon to 22 million individuals across the country. We want aid to Ukraine. There's a number of pieces that are problematic from the market perspective, suspending BLS data. A lot of chips to play here, and there are cards for both sides to deal.
On the BLS data, even if we get a shutdown, do you think we will get Friday's jobs report?
I'm optimistic that we'll get Friday's report because basically the president is going to have to decide that he just doesn't want to turn the internet on that day in order to avoid it. And I think the market's going to respond really negatively to that. In meetings across New York with investors last week, this came up in every single conversation. We've already had to deal with the firing of the BLS commissioner earlier this summer. And, you know, we're dealing with fiscal dominance on the Fed side and even at the Supreme Court. The market's going to react here. And given the timing where we can collect data all the way through the 30th of September until midnight, and then the jobs report is just 48 hours away, that should be pretty much finalized. All the commissioner really has to do is press send. We should get skeptical about reports coming 3, 4, 5 weeks later, maybe even 5 days later if you want to get to it. But at this point, refusing to release the BLS data is going to be a problem for the markets. And I think that cooler heads will hopefully prevail on that one.
Okay, so you think we get Friday's report, but looking forward, it's a little bit more murky depending on how long the shutdown could be. In Trump's first term, we saw a 35-day shutdown. Do you think we could see something as elongated as that?
That's not current conventional wisdom amongst staff. I'd point to a dynamic on the Hill, which is that of the 750,000 employees that are going to be furloughed in this shutdown event, a lot of them get paid on every other Friday. And so that, in this case, is October 10th. And that points to a relatively short 10, 11, 12, 13-day shutdown where staff can then get back paid as late as Monday, something like that. So that every other Friday dynamic is just a little inside baseball tidbit to keep in mind if you're an investor watching how long this could shut down. Their staff starts to hurt and feel it by the 10th.
Who do you think is going to get the political blowback when it comes to a government shutdown, Republicans or Democrats?
Well, polling suggests that Republicans are going to fault Democrats and Democrats are going to fault Republicans. The reality of the situation is that it's hard for Republicans to message that it's somehow not their fault, given that they control the White House, the House, and the Senate. Americans are used to Republicans being the driving force behind a shutdown. So in 2018 and 19, it was President Trump advocating for a border wall. Before that, it was Ted Cruz, if I'm not mistaken, on the Senate side. So this is a situation where Democrats usually are not in this position. They're always the ones that fold like a lawn chair, which I know we've talked about in years past. This is a dynamic that's a little bit fresh, and they're fighting over ACA subsidies, which is an old saw for them. They feel like they've got the American public understanding that they're the more trusted party on healthcare. When I talk to staff, there's some reticence about moving it to a tariff discussion, which polls very well for them and very poorly for the president, but they're really sticking to healthcare. I think it's bad look for everybody personally.
Speaking of tariffs, you mentioned China. China has not booked a single soybean cargo. How quickly could we see this Congress actually give a bailout to farmers?
I mean, they can put it in the CR right now. This is exactly the narrative. If you're from Nebraska, Illinois, any of the farming states, if you're Chuck Grassley, you've seen that he's furious over the weekend because Secretary Bessent is planning a $20 billion bailout for Argentina, who simultaneously is getting all the soy purchases from China and stealing our market share. That's permanent spending loss. If you look at soy data, it's really fascinating. In the president's first term, they were selling over 14 billion bushels of $1 billion worth of bushels of soy to China every year. Now we're already down to 12. And given the extent of this trade war, we're now selling 0 to China. So the trajectory under Trump for farmers has been straight down, and now it's in bankruptcy territory. So there's a lot of impetus for Republican lawmakers on the House and Senate side to insert a bailout for farmers in this CR as they are going to go bankrupt with their soy, just rotting on the vine right now.
So you're saying they could do it as soon as this CR. Will they? Will the Democrats also sign up for that?
I think there's enough opportunity for give and take on both sides. In one case, you avoid a government shutdown, which is, I think, going to disproportionately hurt Democrats this time around. Russ Vaught at OMB is making it really clear that he wants to have this be as much blue state targeted as possible. Plus, you want the health care subsidies. Plus, you want additional potential assistance to Ukraine. Plus, you want a farmer's bailout. There's a lot to go around here, and I like that. That's usually how you can get a resolution. This could become, maybe not by Wednesday, but shortly thereafter, if they get a little bit of a stopgap, a much bigger deal.
Henrietta, thank you so much for your time this morning. That's, of course, Henrietta Trace of Veda Partners. Jonathan, she thinks there's potential for an off-ramp before midnight tomorrow. And most importantly for financial markets, she thinks we get the jobs report on Friday.
Anne-Marie, fingers crossed. Hopefully we will this coming Friday. MH, thank you. Anne-Marie bringing up the right story there. Soybeans. This relationship between China and America over that one issue is problematic. They've been leaning on Brazil for a long time to build up a more reliable source of soybeans. And now we've got a domestic problem in the US that the government arguably needs to address.
And part of the way that they're going to address this potentially is to take money that they're getting from the tariffs and giving subsidies to soy farmers. Look, this is a real question of which constituents are going to get hit hardest from which parts of this dispersion between the US and China, as well as some of the tariff revenues. How does this administration deal with it? How much pushback do you get from certain Republican Congress members in response to select policies? This is where I'm watching to understand what carve-outs are really asked for or what subsidies are requested.
Unfortunately, this has been a strategy of the Chinese for quite a while now, to put some heat on the Republican states, to try and put some heat on the administration led by President Trump. We'll see if we get changes on that issue. Coming up on the programme, we'll catch up with the PIMCO CEO, Manny Roman, on financing the AI infrastructure boom and a whole lot more. Plus, Danny, has your morning movers Carnival shares higher ahead of their latest earnings report? That stock is up by 1.6%. From New York City this morning, good morning to you all. Equity futures positive by 0.5%. In the bond market, a rally. Yields down on a 10-year maturity by 3 basis points. Your yield this morning, 4.15.
It's the most fascinating time for the global economy in years, and our conversations are front and centre.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Live from New York City this morning, good morning. Equity futures on the S&P 500 positive by 0.4%. A lift in this market following Friday's gains, snapping a three-day losing streak. On the Nasdaq 100 this morning, higher by 0.5. If you switch at the board and get to the bond market, 2-year, 10-year and 30-year bond yields down across the board this morning, down by 1 on 2s, down by 2 on 10s. Your 10-year 4.15, going into a week full of economic data where we hope, and I keep saying that word, we hope we get the payrolls report this coming Friday.
If the government shuts down, we probably will not get that labor market report, and then all of a sudden we will have a jolt report that's going to jolt a market disproportionately. The volatility on the heels of all the peripheral measures, I think, is what to watch this week.
If you are intrigued by the payrolls report, if we get it, the median estimate is 50k, the low is negative 20, and the high is positive 105, and a lot of I don't know somewhere in between. 2 hours from the opening bell, let's get you some single names, some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Occidental rising this morning, up 1.4%. An FT story that they're looking at selling their OxyChem unit. It's their petrochemical unit. It would go for about $10 billion. They didn't name a buyer, but they have been offloading a lot of their assets in a bid to reduce some of their debt. So again, those shares rising this morning. Also rising ahead of their earnings is Carnival Cruises. Those shares up 1.2%. They'll be reporting their earnings at 9:15 or thereabouts a.m. this morning. A lot of enthusiasm about it. Barclays points out that they're probably going to come out with a strong showing, especially given that some of their peers, Royal Caribbean, alongside some of the other ones like Norwegian Cruises, have been doing really well. By the way, Matt Miller and I will be speaking to the Norwegian Cruises CEO in the 10 a.m. hour, so one to pay attention to later this morning. Finally, wrapping things up with wheat stocks this morning. Having an excellent morning. Tilray up 18%, for example. Canopy up 14%. Aurora Cannabis up 10.7%. After President Trump put a video on Truth Social, kind of looks like an infomercial sort of thing that touted the benefits for CBD for seniors. So off the back of that, you get this rally. John?
Danny, thank you. More from Danny in the next hour. Appreciate it. Danny, thank you. On a radar this morning, President Donald Trump saying negotiations for a Gaza peace deal are in their final stages. The president meeting today with Israeli Prime Minister Benjamin Netanyahu at the White House. President Trump meeting with a bipartisan group of congressional leaders as well today as a government shutdown looms. Trump says the shutdown is likely unless Democrats drop their demands to extend health insurance subsidies. And finally, Vice President J.D. Vance saying he's confident that US version of TikTok has been successfully separated from its Chinese parent company. President Trump signing an executive order last week approving the proposed deal.
There's still a lot of questions about exactly what the parameters of this are. Oracle to own something like 45% of it, and then this idea that the ByteDance operation over in China will get 50% of the profits from the U.S. entity, but the algorithm will be run by the United States. A lot of questions about Xi signing off on this, what exactly this is contingent on, and this really has raised a lot of questions about the larger deal. People saying this was incremental, more discussion about what else has been agreed upon between Xi Jinping and President Donald Trump.
It's the price I want to talk about. Brent Thill was joining us a little bit later.
You mean that it's nothing?
It's like nothing.
Yes.
Compared to what this would get if they just span it off.
Yeah, so what do you think of that? Do you think that this was just sort of a devaluation to give an easy, cheap entry point to the U.S. investors coming in? Do you think that this is trying to downplay the value of this asset in the United States? I mean, what's the ramification given the fact that it should be twice as expensive at least?
I'll let others speculate. I'll just say that those that have got their fingers in this pie have done pretty well and will do pretty well in the years to come based on the appetite for that app.
We all feel for Larry Ellison about how he's done so far and are really happy to hear that he's added to his wealth. Congratulations.
I don't even think the smallest violin. I can't even play that. But Larry's life is just so good.
It's ridiculous. I mean, honestly, between the sailing and his private islands and his endless wealth, yes.
He's having a good time, let's put it that way. Let's stick with tech. McKinsey estimating that data centers will require $6.7 trillion to meet demand for computing power globally by 2030. Private credit firms are laying the groundwork to help provide the capital. Meta is said to have selected PIMCO to help lead a $29 billion financing for its data center expansion. I'm happy to say the PIMCO CEO, Manny Roman, joins us now for more. Manny, good morning.
Good morning, Jonathan. Nice to see you.
It's good to see you, sir. How does a man like you deal with a 3 a.m. alarm clock on the West Coast? How does that work? You've got
I make the best espresso known to mankind. You know, and you'll be happy.
Triple espresso?
Triple espresso. And it feels good every day and happy to be at work.
Well, I'm happy to have you with us this morning. Let's get into some of these deals. I know there's certain deals you can talk about, can't talk about. I want to talk in broad terms about the appetite here. For the capital that we need to provide to this particular force, this growing force, AI data centers, where it's going to come from, and where you and the team are going to fit in?
So I think it's a huge, super secular opportunity. There is an enormous need for funding and equity in data center. I don't know whether the $6.7 trillion from McKinsey is remotely right, but it's very, very big, and there'll be plenty of financing deals to be done, and there'll be plenty of construction to be done, and it's true in the US, but it's true in other parts of the world. And the need also to have the infrastructure and the energy will come after that. So, we all talk about data center, but there's going to be a real rush for energy in terms of providing the right setup for all this data center. And, that's one of the reasons to be very bullish on natural gas.
We've reflected on one particular statement from one particular tech CEO over the last 12 months that I think was really quite important. It was last summer. It was the Alphabet CEO, when essentially he said that the greatest risk here was underinvesting and not overinvesting. And I wonder how you think about that from the perspective as an asset manager, when you've got a group of companies that are willing to run the risk of overinvesting. How do you think about the risk around it?
In terms of, I think what we will do is we will look at every single deal and we will say this makes sense for us and this may make less sense. And I think one of the strengths we have is to be pretty focused on relative value and sort of think that there may be a fantastic deal to be done, which will be very, very good for our investors. And then we'll look at the next one in the full light of day and decide whether it fits our portfolio and whether this is something we want to do.
I think it's important to build on this, that Mark Rowan said recently, we are what we originate. When it comes to private markets, you are what you originate. It's quite labour intensive. It takes a lot of work. When you think about scaling this and building this as an opportunity, how difficult is it in practice?
I think we have built it differently from Mark. We have built it based on our experience in fixed income, our experience in relative value, in a history of 54 years, in looking at all sorts of credit. We have 55 credit analysts who looks at every single segment of the market. And I think we look at it from a value standpoint. Does it make sense? Is it something we want to do? We shouldn't be originating for the sake of originating. And there's a lot of money coming to this market. Some sectors will be very attractive and some will be less so. And I think you want to be very much on top of this and say, I want to do this and I want to do less of this.
There's a concern, especially as CEOs say, it's more important to be throwing enough money at this rather than being underinvested. And then you have people like David Heinhorn of Greenlight coming out and saying the numbers that are being thrown around are so extreme that it's really, really hard to understand them. How difficult is it to invest in a market where people are throwing spaghetti at the wall to try to understand what's going to stick? And there is a feeling of excess that continues to bubble up around this.
So my friend Richard Thaler, who is an economic Nobel Prize and consult for us, has this say. He says, when you make long-term prediction, the degree of humidity and the standard deviation around the estimate should be very, very big. So when I hear an estimate like $6.7 trillion, I don't know what to make of it. David may very well be right, but we'll take it one step at a time. I think 6 months horizon is about all we can do in terms of the demand. And then, the environment may change dramatically. There are business cycles. Sometimes things are cheap, sometimes they're expensive. If there's a recession, all of a sudden spreads will widen. Company may revisit what they're trying to do, and so on and so forth.
So this is the difficulty. How do you have a 6-month horizon when a lot of these investments are 10-year build-outs, when they're 10-year usage, when they are labor-intensive, and infrastructure projects by nature are a lot longer than 6 months?
So in terms of committing capital and in terms of finding the right opportunity with the right length of time, we're totally fine to have a very long-term horizon. What I'm saying is making long-term prediction in terms of how big the market will be, it's very hard. I think you have some visibility over the next 6 months in terms of what the demand is, what the real demand is, and whether that slows down or whether that accelerates. You just don't know. And I think you have to be very humble about these things and just say, look, we'll take it one step at a time and see what the market gives us. And by the way, there may be other opportunities which are more attractive. You look, for example, in our asset-backed finance business, aircraft leasing. Aircraft leasing is incredibly interesting, and then nothing happens for 5 years, and then it becomes very interesting again. And you gotta constantly say to yourself, are there better opportunities for me to deploy money? And what do I want to do? How do I think about the risk? How will I get out? What's the right risk-return profile?
You made a headline recently. Wanted to ask you about it. Private markets haven't been tested. Can you build that out a little bit more? What did you mean when you said that private markets haven't been tested?
Well, my partner, Dan Iverson, and our CIO of Core, Mohit Mittal, have the charts. And we checked the number about 20 times because we kind of didn't believe it. But it shows the return on weak single B, which is a reasonably good proxy for direct lending. And what you see is you make money because the yield is higher. And then there's a recession, and then you lose it all. And so I'm old enough to remember 1991. I saw that. You know, there's a recession which came out of nowhere from, you know, essentially SNL having too much high yield. 1997, the world is absolutely fine until there's an Asian crisis, and then you have LTCM, and then things become very cheap. And so you got to remember these things. And we have been in a period since 2009 of exceptionalism, where you have had very strong equity return and very strong high yield return. If you believe this is going to continue for the next 15 years, then I think you should have the same position. But it may not be the case. And I think we bring that and say the data is at the data.
Do you see parallels between now and those periods?
Well, I think with the initial condition where we are right now are such that equity markets are expensive by any measure. They may go higher because momentum is strong, and credit market are tight in some part of the spectrum. And I think that's the reality. And look, we've been in a period where things are expensive for a long time. 2005, 2006, were such period where things remain expensive and became more expensive, and then something breaks, and then all of a sudden you have a lot of work to be done.
We're going to spend some time on that in just a moment. Manny Roman's going to stick with us, the PIMCO CEO, Manny Roman. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Lufthansa is planning to cut 4,000 administrative jobs by 2030 as the carrier seeks to improve profitability. The job reductions will occur through digitalization, automation, and process consolidation, with a majority of the reductions in Germany. Meanwhile, First Brands has filed for Chapter 11 bankruptcy. A group of creditors are set to provide the automotive parts company with $1.1 billion in debtor-in-possession financing to keep operations running. This comes after mounting scrutiny over First Brands' reliance on borrowing against future cash flows. And gold is pushing to a fresh record above $3,800 an ounce. The precious metal is getting a boost from investors concerned about a potential government shutdown and pulling back from the U.S. dollar. Other metals, including silver, palladium, and platinum, are also rallying. Gold is up over 45% this year. That's your Bloomberg Brief. John?
What a rally for 2025. Yahira, thank you. More from Yahira in about 30 minutes' time. Up next, excessively restrictive.
The neutral rate is drifting down, and as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
That conversation will continue with the PIMCO CEO, Manny Roman, live from New York City this morning. You're watching Bloomberg TV.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Live from New York City this morning. Good morning to all. Equity futures on the S&P 500 firmer here by 0.4%. Likewise on the Nasdaq, higher by 0.5%. Under surveillance this morning, excessively restrictive.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
Investors turning their attention to this week's Fed speak and the jobs data after Friday's soft inflation print. The PIMCO CEO, Manny Roman, is still with us and he's back for more. Manny, let's continue the conversation we were having. Equity markets very close to all-time highs, credit spreads near multi-decade tights on investment grade, high-yield spreads near the tights of the year. And yet we've got a Fed official saying that we're excessively restrictive. You're across a range of funds. You look across markets all the time and the economy with the team. Do you see any signs that we're excessively restrictive?
Well, I think rates are very high across the globe, right? And I think part of the reason why I get up so early and happy to go to work is because the opportunity has never been better. And we talk here about the US, but look at the UK. The UK, where you're from, is 10-year rates are 4.75. Australia looks really, really attractive. So when we think about the opportunity in a way, yes, we do expect the Fed to cut. How much they're going to cut next year remains to be proven. No one knows what's going to happen to the labor market. But the reality is the opportunity in terms of global fixed income is very, very big. And the opportunity to add alpha is quite high. I'll tell you a funny story. We have a partner in Tokyo called Tomoya Masano. And, for the longest time, there's not much happening in Tokyo. So you sort of call him and you have matcha with him and not much is happening. And then all of a sudden, the Japanese fixed income market becomes super exciting. And then there's a lot to do. And there's a whole generation of people who have disappeared because they don't do it anymore. And so you have a labor market which hasn't supplied fixed income investor because there was nothing to do for the longest time. And so what I think is interesting is the difference of view, the difference of opinion is also a source of incredible alpha. And, if you want to think about why performance has been quite good, it's partially because the alpha that is being given by the market is quite good.
I think it's interesting that John was talking about the Fed and you talk about the international sphere. And I think that that's really telling about what people are looking to for that alpha, for that incremental extra yield. Are those Japanese investors staying in Japan right now and not coming to the U.S. for treasuries, even if the Fed cuts?
No, I think they're very big investors in U.S. assets. And remember, one of the opportunity everyone has is to buy foreign assets and swap them back into dollars or swap them back into yen and so on and so forth. And so you can actually buy synthetic credit, you can buy synthetic dollar exposure for US investors buying, for example, JGB and selling forward the yen into dollar and having a different credit risk with JGB than you have with US dollar. And so there's a lot to do. Now, we do that a lot in short term and longer term in terms of adding alpha, but all the time you can do this sort of transaction and sort of, mitigate your exposure or increase your exposure or have different risk profile.
That's a much smarter way of looking at it. I'm looking at this with sort of a blunt instrument, sort of do you like international more than the United States?
But I mean,
and you come up with this really wonderful, nuanced view.
Japan has an enormous amount of money to put to work and is a nation of savers. And so there's the thing that I always say is you need to put your money somewhere. And the reality is the US is the only place where you can actually put scale. And when you want to think, for example, of the Australian problem, there was a whole delegation last week from the UN from Australia. They need to move capital away from Australia because they are a nation of savers and the Australian market is not big enough for them, and so they need to pivot to...
For a long time, Japan had to do the same thing. They didn't have the yield. To your point, the story's changed. One thing we're trying to track is whether the Japanese bring the money home, whether we see this great repatriation where it could leave markets vulnerable, where typically they deploy that capital. I'm thinking of certain European markets, the US as well. Are you seeing any of that flow story start to turn?
No, not so far.
Would you expect it to change?
Honestly, not really. These things are very, very slow to move. And the reality is people keep on saving in Japan. And so it may just be that the marginal dollar goes into JGB, but the credit markets are very underdeveloped. And if you want to buy, for example, single A exposure, you're much better off going to the US.
The conversation we had back in April was maybe the decline of US exceptionalism. The money was going to leave, it was going to go elsewhere. I want to understand where you are now 6 months later. What did you see at the time in April? Did we start to see that decay click into US exceptionalism? And are we back to where we were at the start of the year just 6 months later?
So I think we were dollar underweighted. We literally just square off our position. We still very much like emerging market currency. We do like Australian dollars. There's plenty to do, but there was a short dollar position to be had, and it moved 10%, and I think we decided to square our position.
You're talking a lot about rates and the era of income. We've been talking a lot about that just based on the fact that yield has been higher. We're talking about private investments through infrastructure. You're not mentioning equities. And this is a time when people are talking about...
I'm a fixed income guy.
No, I know, and where you have sympathy with us. But I'm wondering how much a higher rate regime limits future equity returns. We used to talk about that. That was before 3 years consecutive 20+% returns. I mean, at what point will it constrain the equity side of the portfolio, even though some people are wondering what kind of buffer bonds really provide?
Well, the PIMCO view is that equity return in the US is going to be 6% for the next 3 years or something like this. I mean, we look at CAPE valuation, it's trading at 28 times earnings. It looks really, really high to us. We understand the excitement about the hyperscaler, but if you look outside of the hyperscaler, life in industrial America isn't great. I mean, top line is not growing, and one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin, and so on and so forth. And we don't know that, and so there's a whole leg of the equation that we haven't really seen.
Stock investors have been trying to outbull each other this morning, and Max Kettner was on earlier of HSBC, and he was saying, look, he thinks that the Fed is making a policy error by cutting more significantly, but they're along for the ride because it's just going to inflate the prices of assets significantly. They want to gain from that. Do you agree with that assessment?
Well, I haven't listened to him, so I would not be.
Good initial punt. I mean, do you think? Yeah.
I don't know. We have a lot of trust in the Fed in terms of them doing the right thing, and I think that the Fed usually doesn't know much more than we all do. They look at the same data, and so the decision is a very well thought out decision where they will decide what to do with the condition that they are being given. And if, for example, we were to see a very bad inflation print, it would be very difficult for them to cut. Now, they may argue that they have to look through inflation and so on and so forth, but the Fed is a very rational actor in the market, and I don't think anything's going to change. And the same goes for the central bank in the UK and the ECB and so on and so forth. And I think once you're in a job, your behavior changes also in terms of how you think about what the right thing to do is.
Are you alluding to the new Fed chair next year?
No,
when you say that?
I'm just saying it's like being a Supreme Court justice. You know, it's a very important job, and I think people take their job very seriously.
There could be a big change next year. There's going to be a new Fed chair. Do you expect to see any daylight between a Fed chair appointed by this White House and Chairman Jay Powell and his current leadership?
You know, I was reflecting on this, and we were talking about this. I mean, every single Fed chair has been, to some degree, a political appointee. And, you know, there's been a history of very good Fed chair since the Burns and the Nixon presidency. And I see no reason why that would change.
The list of candidates we've seen so far, we've said it repeatedly, very credible names on that list from this White House and the Treasury.
Yeah. And it is important to remember that it's in everyone's incentive to have a very credible Fed chair, because the market will not like a non-credible Fed chair.
You're running?
I was going to say
you fancy
the same
it?
thing.
No, you're happy on the West Coast, right?
He didn't answer us. That means yes, he's confirmed.
I don't think Manny wants that job. Manny, it's good to see you. Thank you, sir.
Good to see you. Thank you for having me.
We'll do this in Newport next time, okay?
Absolutely.
When the weather starts to warm up a little bit around spring.
When it's very cold in New York City.
Either,
right.
you know, the winter time of the year works for me.
Vacation?
You know, January time.
Play golf.
Yeah, we'll try and make that happen. All right. Manny, thank you, sir. Appreciate it. Manny Roman there, the PIMCO CEO. Coming up, Jonathan Golub of Seaport Global, Brent Thill of Jefferies, Lindsay Piegza of Stifel, and Jim Karen of Morgan Stanley. The third hour of Bloomberg Surveillance is up next.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
We lost some of that underlying momentum in the equity market.
We're heading towards a seasonally weaker October.
It is getting more challenging as the valuations are getting tapped out.
We are relying on such a small cohort of names to drive this kind of upside.
There's as much melt-up risk as there is meltdown.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures positive by 0.5% on the S&P 500. On the Nasdaq, up by 0.6. In the bond market, a rally, yields down by 3 basis points on 10s, ahead of a massive week for economic data.
Yeah, that's supposed to be capped off by non-farm payrolls that we probably won't get, although maybe there'll be some deals struck the next 24 hours after that October 1st deadline. Look, this is going to be a week where all the other data is going to take on that much importance. I feel like a broken record, but at the same time, the ISM manufacturing tomorrow, the JOLTS job openings data, the sentiment data, what we get from ADP, all of these other metrics are going to take on that much more importance, because if we don't get the non-farm payrolls on Friday, and we don't get CPI in the following week, the Fed has no new information before their next meeting.
We've got a deal to work through as well.
Yeah.
The team at Bloomberg leading the reporting on this, just confirmed by the company itself, video game maker Electronic Arts going private at about $210 a share. This is a $50 billion plus deal. The agreement and the investors behind it, Silver Lake Management, Saudi Arabia's Public Investment Fund, and Jared Kushner's Affinity Partners.
And it comes with a 25% premium to Electronic Arts' closing price on Friday. This is one of the largest leverage buyouts ever. I believe it would be one of the year's biggest deals, potentially the largest buyout on record. And it raises a question about where we are in the cycle. When you start to see massive leverage buyouts, it doesn't make you feel like you're at the beginning stages of some sort of rally or market cycle. So does this feed into this idea that we're reaching some sort of pinnacle or euphoric kind of feel, or is this just what makes sense, has been on hold for the past 3 years as people remained on the sidelines?
Idiosyncratic gets thrown around a lot, but I'd say this is another data point in a long list of data points that you've just gone through about where markets are right now. The door is wide open for deal making, and if anything, this Fed's about to juice things even further with rate reductions.
So it goes to this conundrum that Stephen Myron tried to parse out, the idea of financial conditions being conflated with Fed monetary policy. A lot of people could argue, myself included, depending on what hat I'm wearing, that if you do cut rates, that would be easing financial conditions at a time where the financial conditions already are incredibly easy. Other people might say, well, there are different sets of factors with those leverage buyouts that might be reasonable and have nothing to do with Fed policy. Nonetheless, you can imagine if the Fed cuts rates, it will only encourage more of this.
Let's take the Max Kettler argument over at HSBC. Max is super bullish if you didn't know. Max is essentially saying that there are things that matter to the equity market and things that matter to the Federal Reserve. And the things that matter to the equity market are pretty good right now. Big tech's doing okay, printing money, earning loads, stocks are higher, fantastic. The things that matter to the Fed, not so great right now. Labour market's seen a real step down in payrolls growth. They're the kind of things that make the Fed nervous. They've got to respond to it. So as far as he's concerned, the market gets the best of both worlds. Gets the profit profile of the big tech players, or the S&P 500, also gets the rate cuts from the Federal Reserve as they respond to nervousness about the labour market. And in his view, you get the asset price inflation that he wants to be on top of. That's the train he wants to ride.
My issue with that, and I think that you're right, I think a lot of people would agree with that, which is the reason why you're seeing upgrades from Goldman Sachs, from BMO, from others. The only issue from that is if you have a hammer, everything is a nail. And for the Federal Reserve, they might be trying to solve a problem with the wrong tools. And that might be the asset price bubble. And he was saying he does think it's going to be a policy mistake. I'm talking about Max Kettner now. But it doesn't mean you shouldn't go along for the ride, which is what a lot of people are saying.
Guess what stocks are doing this morning? Up again, up by 0.5% on the S&P 500. Coming up this hour, Jonathan Gollum's back of Seaport Global as stocks trade near all-time highs. We'll catch up with Brent Thill of Jefferies on why he thinks the US TikTok deal is massively undervalued. And Lindsay Piegza of Stifel as investors await the latest payroll data later this week. We begin this hour with stocks edging higher as bullishness in tech stocks continues to grow. Jonathan Gollum of Seaport Global writing, consensus narrative holds that irrational exuberance towards AI is the driving force behind the success of tech. The data contradicts those assertions, pointing to superior earnings. Jonathan joins us now for more. Jonathan, good morning.
Morning.
And congratulations, sir. You're an old friend, and it's great to see you in a new seat.
Yeah, I mean, I could not be more excited about Seaport. It's just this really cool, small boutique research shop, and 30 fantastic senior analysts. It's really great to be part of it.
It's cool to get the opportunity to catch up with you first right here on Bloomberg. So let's talk about your recent views. You've heard the term irrational exuberance back in the 90s. It's on repeat. Here we are in 2025. You think it's misplaced? Let's start with why.
Well, I mean, you take a look at, let's say, the third quarter earnings outlook. The big tech companies are just keep ratcheting, the expectations just keep ratcheting higher and higher. These are not stories where valuations are going up because investors are exuberant. The investor class keeps underestimating how good the earnings picture is. They crushed earnings during the last earnings season. The estimates on these names keeps getting pushed higher. And the stock prices are not higher in valuations on big tech. They're flat for the year. And the reason is because the earnings are driving the superior results.
Can you say the same thing about the rest of the S&P 500?
No, I mean, it's kind of a strange thing that if you actually say, well, what's expensive? The rest of the market is not being driven by earnings, and it's being driven by valuations. I would argue that investors around the world are getting sucked into the U.S. market because of great tech earnings. And then what are they, and then you buy this larger basket, and the valuations are going up on the non-tech part of the market. And the tech stuff seems incredibly healthy.
So it's the Magnificent Six. That's what you're arguing for, that should be what people invest in. Who gets kicked out of the Magnificent Seven?
Well, first of all, I don't consider Tesla a tech stock. So I don't include it, not because it's not a wonderful company, but it's just not part of it. But I don't think we should be looking at these companies and saying, they're doing really well, let's create an acronym and just kind of shove their name in and then we switch again.
This is what Wall Street does.
No, but it's silly. I mean, there are 6 huge tech companies that are growing at this unbelievable pace, at these very high profit margins. And here's the key. The stock prices are following the earnings growth of these companies. They're the biggest 6. It's not like we can listen. You and I can go and if we want to come up with an acronym, we can throw Oracle in there. It said great returns, and let's throw Palantir in there. And we'll sit there with the Scrabble board. Yeah. That's not what it's about. It's like these are the big names, and they're big not because we fell in love with them. They're big because they're just out-earning everything.
So at a certain point, are you saying that you could see gains driven by the magnificent whatever, by big tech stocks, and at the same time, you end up with the rest of the index falling further behind, and that equal weight, which everyone has been trying to go to, actually underperforming yet again for another year?
Probably will. No, yeah, I mean, and if you take a look at, let's say, for example, the S&P X the Big Six, and then you look at global equities, they kind of look the same. The non-U.S. basket and the U.S. basket X these 6 companies, they sort of feel alike. I mean, I've talked to global investors recently who are kind of doing a barbell. That, in their global portfolio, they're buying these companies that you can only get in the U.S., and then the rest of the portfolio, they're putting their dollars in other sectors abroad, and that's how they're coming up with their balance.
Is that
and it makes sense.
Diversify the exchange rate? Diversification story, the exposure to the US dollar. What is that about? Is it just about getting exposure to the European bank rally? What's the diversification abroad about?
Well, first of all, if you look at the outperformance we've had year to date of non-U.S., it's nothing but a currency issue. So the underlying earnings are still better in the U.S. and the like. But if you're running a global equity fund, you feel compelled to have similar, weights to the benchmark. So if you want to grab all of this exposure in these big tech numbers in the U.S., so you buy a consumer staple company in Europe because, well, a consumer staple company in Europe kind of feels like a U.S. consumer staple company.
Do you have questions about U.S. equity market exceptionalism? Do you have any questions about that at all?
I mean, not right now. I mean, there's a ton of reasons why, over the long run, the U.S. should do better. I mean, we have, if you look at the venture capital industry, which has embedded itself in our universities, and the fact that it's not a surprise that not only the top 6, but if you look at the suite of the top 20 tech companies, the vast majority of them are in the U.S. There's something about the operating environment that we have here that is, that creates.
John, I would also say the deep pool of risk-seeking capital. I remember Jeff Bezos came out and talked about the secret sauce of the American economy. It's the fact that you can raise $50 billion just like that, for something that may or may not succeed. And we've seen something else like that again this morning with another deal announced. These are the kind of deals that you would only see in America. You wouldn't see a deal like that elsewhere this morning.
Yeah, although some people might say that that's the folly, potentially, of the market cycle, too, which is one thing that people will, potentially...
I just want to jump in on something you said.
Please.
The liquidity on U.S. companies is just much better. Part of it is that there's more regular reporting in the U.S. with quarterly reporting. Rather, I don't mean to be a high point on that.
Hey, John, you've gone there. So let's talk about it. No, you touched it.
But there's a whole bunch of reasons why when non-U.S. companies re-domicile into the U.S., their stock prices go, and it's not just simply because people are chasing them. It's the U.S. market is deeper, it's more liquid, and
are we putting it at risk? Are we putting it at risk? You talked about quarterly reporting. You're alluding to changes we might see from the SEC. Are we putting some of that at risk?
Well, there's a really simple bottom line on this. Investors want transparency. If the government says you only need to report every 6 months, large companies are going to who go to semi-annual reporting, whether it's voluntarily or required. If they move to semi-annual, their stock prices are going to go down because they're providing less liquidity. They will voluntarily report quarterly because someone is going to tell the board, rightly, if you do not provide transparency, your stock price is going to sell at a lower price, and they are not going to do that.
We've had an entire conversation about U.S. equities without talking about the Fed. Is that just not even on your radar?
It's first. Let's look at what I think the biggest issue, because you talked about if they don't get this incremental information, are they go? What are they? What are they going to do? The bottom line is that the market expects another 4 cuts between now and the end of 26. And so we need to kind of extend the horizon. The Fed is going to be friendly to capital markets over the next, year plus. And whether or not we're talking about what the makeup of the Fed is or what they do in the next 2 meetings, it really doesn't matter. What really is driving the market from a credit point of view, the market is like 5 times more sensitive to high yield spreads. And you talked about, one of you talked about financial conditions. If you look at the Chicago Fed's measure of financial conditions, if you look at the St. Louis Fed's measure of financial conditions, you have an environment where liquidity is plentiful, the market is operating well, and I totally agree with your when you're talking about Max, I think it was before.
Sure.
And the things that the Fed sees is they don't have a growth and inflation mandate. They have a jobs and inflation mandate. So the Fed is reading a weak jobs environment, and they need to do. And you talked about it a second ago. They only have one tool, and it's a big hammer, But so they're gonna feel compelled. According to the Bloomberg survey, 50,000 jobs are going to be created this month. Whether we get the report on that or not, more than 50,000 people enter the labor market. You could argue that this means the labor market's moving back. The Fed has to act in response to that, and yet you have financial conditions are great, GDP is strong, and the backdrop for stocks is really liquid.
The pain trade's higher? Is that what you're expecting?
What was that?
The pain trade just continues to be higher.
Yeah, and I think that folks who are fighting, it's not just fighting the tape and people adjusting their numbers because their targets are too far behind the market. That's not the story. The earnings are coming through. The market's expecting somewhere between like 11 and 14% earnings growth for each of the next 3 years. We're like super conservative, and we're expecting high single digits, and that's a big haircut compared to the consensus.
Jonathan, it's good to see you.
Good to be here.
Thank you, sir. It's nice to have you back in action. Jonathan Golub there of Seaport Global. Your equity market right now up by 0.5%. That is a major go-private deal announced about 10 minutes ago.
Yeah, Electronic Arts with a potential price tag that's 25% premium, raising questions about what that means for financial conditions, how loose they are, how loose they can get if the Federal Reserve cuts rates further.
That stock is higher so far this morning. That will start trading again going into the opening bell, I imagine. 210 is the per share agreement with a range of companies this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump said the government is likely to shut down unless Democrats back down from their demands. Senate Minority Leader Chuck Schumer says a stopgap has to include an extension of health care subsidies. The top 4 congressional leaders will meet with the president today at the White House, just a day before funding is set to run out. And as you all were just discussing, video game maker Electronic Arts is going private. The deal values the company at $55 billion. That's the largest leverage buyout on record. The consortium, which includes Silver Lake Management, Saudi Arabia's Public Investment Fund, and Jared Kushner's Affinity Partners, agreed to pay $210 per share in cash. And President Donald Trump has ordered his administration to declassify and release all government records related to Amelia Earhart, her final trip, and everything else about her. Earhart vanished during her groundbreaking flight around the world, one of aviation's greatest mysteries. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next, the Morning Calls, plus we'll catch up with Ed Ludlow on the deal to keep TikTok in the United States.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Rates are very high across the globe, right? And I think part of the reason why I get up so early and happy to go to work is because the opportunity has never been better. The reality is the opportunity in terms of global fixed income is very, very big, and the opportunity to add alpha is quite high.
Triple espresso. PIMCO CEO. Manny Roman. That's how he wakes up at 3 a.m. on the West Coast.
주문 청산이 완료되었습니다.
Yeah, ditto.
I try 4.
Is that what you do?
No, I can't. I'd be shaking.
체결되었습니다. 확인 바랍니다.
That's what you said a little bit earlier. Yeah.
I mean, that's what happens when you have
In case you missed it. What are we now? Contrarian Courtney. Okay. Struggling to keep up with you this morning. A rare catch-up with Manny Roman. Great to hear from him, as always. Equity futures on the S&P 500, positive here by 0.5. On the Nasdaq, up by 0.6. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Wells Fargo to equal weight, noting the key catalyst of asset cap removal has passed, limiting upside. That stock is down by a third. Your second call from Wells Fargo downgrading Western Alliance to underweight, saying it won't benefit from interest rate cuts until next year. That stock is down by 1.4%. And finally, Deutsche Bank raising its price target on Intel to 30, applauding steps taken to bolster its balance sheet. The stock is negative here by 1.5% after a major rally over the last few weeks. That's some of these single names, some of the morning calls. Let's stick with tech. President Donald Trump signing an executive order advancing a proposal that would allow TikTok to continue operating in the US, but the details still remain somewhat elusive. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome back to the programme, buddy. What's the latest for this deal?
Yeah, I think the latest is a scramble across Washington, D.C. and the investor base to understand if the structure of this deal, which a source phoned me Friday night to read me from the piece of paper, is compliant with the 2024 divestment law. You know, I defer to AMH on kind of the broader which trumps, pardon the pun it, you know, a congressional mandated piece of legislation or an executive order. But basically, ByteDance having 19.9% in the US-only entity maintains the status quo that it still has some broader majority ownership of the global entity and operational or profit-sharing control. And it's hard, based on the conversations I'm having, for those participants to see how it does comply with last year's piece of rulemaking.
Ed Ludlow with the latest. Ed, looking forward to the show a little bit later this morning with Caroline Hyde, Bloomberg Technology, in about 3 hours' time. I want to extend this conversation with Brent Thill of Jefferies, calling the TikTok deal potentially massively undervalued. Brent, welcome back to the programme. Can we put a number on these things? Just what are these companies paying for this asset, and how does that compare to valuations elsewhere?
Yeah, I mean, it's hard to see because the details at 14 billion, when you think about, you know, half the profits going back, what are all the details underlying? We don't have the full list, but I think the initial figure was massively undervalued. Was that giving, you know, the U.S. and the new owners an opportunity to have some great upside in terms of the equity value? But I think anyway, you look at it, it looked undervalued. Again, we don't know the profit sharing agreement, but when you think about other companies in the social space, when you look at Meta, the rest of the complex, you look at other comparable tech names, it looks, even if they were doing a profit share, it still looks undervalued in our opinion.
Brent, what do you think the ramifications of that are? You think that it's to give a better deal to other people? What's the significance of this for understanding the competitive dynamics of this particular entity as a more U.S.-owned one?
Yeah, I think for the biggest competitor is obviously Meta. We think that no one's going to leave Instagram because now TikTok's up. You look at most of the younger audience, including my older friends, they're between Instagram and TikTok. And then Snap is really a messaging platform for the younger audience, and they're not influenced by any of the campaigns that they run. So there's really not been a lot of advertiser opportunity because the younger audience use it as a messaging tool so the parents can't see their messages, and that's about it. And so the real ramifications really just socially against Meta, and Meta's continued success has been so great in the lock-in and the technology advancements. So we don't believe that advertisers are going to stampede away from Meta. We do think that ultimately, because the stability of the asset will create potentially more excitement for advertisers to potentially come back for those that may be left because there was some distraction going on through this process. So I don't expect, you know, a massive shift in spend. I don't expect a massive loss of advertisers from Instagram, but I think that calming the situation down does help advertisers come back. And then the question becomes, how innovative is the platform going to get now versus where it was at before? And so I think there's a ton of innovation, there's a ton of excitement, but ultimately I think all three platforms serve a different purpose, and most users are going to those three. I don't think consumers can take a fourth and a fifth. I think we've been working through this the last couple of years with how many can we consume, and right now we're seeing, I think, those three, you know, work with each other, and they work in different ways. Snap for comm, Instagram for more professional content, TikTok for more fun content, and you're seeing kind of a in between and hey, I'm getting bored with this platform. Let's go over here. I need to send a message to my buddy. Let's send it here. So I don't think there's going to be any massive changes from what we can see so far, unless there's some massive level of pickup and innovation. We just don't see that. We see Meta actually moving forward, and Zuck mentioning, you know, there's 3 billion people plus on the Instagram platform, I think it speaks to how good that platform is, how good the targeting is.
Yeah.
And the advertisers, all the checks we do, they've been gaining market share against others. So even if, again, assume TikTok is successful in terms of some new innovation, I think it's going to come from other places. I don't think it's going to come from the Meta or Instagram budgets.
Brent, I've got 30 seconds left, just quickly. Just announced the largest leveraged buyout on record, Electronic Arts. I think a long, long time ago, you used to cover this name. What does this make you think? What's your response in 25, 30 seconds, if you can, about the amount of money just sloshing around?
Tech M&A is booming. Tech M&A is going to massively pick up. It has already. We've already seen, companies like Atlassian, and you've seen Workday do, multiple billion-dollar deals just in a month. So, M&A is up in a massive way. You're going to see a lot more, and I think you're going to see bigger deals. We've heard, even companies like IBM say that they can't do deals, over 10 billion. They've taken that away. They've said we can do much bigger deals under this administration. So this is a taste of what I think you're going to continue to see.
Brent, appreciate it. Thank you, sir. Brent Thill of Jefferies on TikTok, and this deal for Electronic Arts, a mega deal this morning.
Yeah, and more to come, as he says. I just want to say, I hope that the next innovation, at least for the kids out there, is pick up a book, read a book. That's a new platform. I think they're good.
I hope that's a new innovation too, but I don't think that's happening. I think that stocks resumed trading. We're up in the pre-market by about 5%. Live from New York City, you're watching Bloomberg TV.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Equity futures still positive here by 0.5% on the S&P 500, up 0.6 on the Nasdaq. Got some Fed speak for you. The Cleveland Fed President Beth Hammer coming out on the hawkish side, as you'd expect. Need to maintain restrictive policy. Inflation expectations concern me most now. That is just the polar opposite of the other side of the spectrum, which is Governor Myron, who is more concerned about the labour market than he is inflation.
And more people seem to be coalescing around prioritizing the labour market. That said, the fact that the Beth Hammocks of the world, Raphael Bostic, has come out in the same kind of place. Even Austin Goolsbee said he needs to really hold off for a bit. He isn't happy. Front-loading rate cuts raises a question about whether the bar is getting a little bit higher for the Fed to cut beyond maybe another 25 basis points or 50 this year.
Range of views is getting wider.
It's getting wider.
Not narrower, it's getting wider. Into a big week full of Fed speak and economic data. In the bond market, yields down across the board on 2s, on 10s. The 10-year down by 2 basis points to 4.15. 2s at 3.63, down about a basis point this morning. For now, though, we need to get you some single names because this morning a massive story. The largest leveraged buyout on record. With the details, here's Danny. Hey, Danny.
John, the price tag, $55 billion to take Electronic Arts private. It's going to be led by the Saudis, PIF, by Jared Kushner's firm, Affinity, as well as Silver Lake. The deal is also buying the shares out at $210 a share, so we're not even quite at those levels yet. 5.6% is the rally that we're seeing pre-market. By the way, the high watermark that this beats of the last big leveraged buyout was a company called TXU. It was a Texas utility company in 2007. That went on to declare bankruptcy and lost its buyers a whole lot of money. Make of that what you will. Some other deal news to work through this morning. This one coming from the FT, that Occidental Petroleum is looking at selling off OxyChem. It's their petrochemical unit. It would be for $10 billion. Should that deal go through, would help Occidental pay down some of its debt, which it has been doing through asset sales. Finally, this morning, we're also looking at the defense companies rallying. Lockheed Martin up 2.1%, RTX up 2.3%. This follows a Wall Street Journal story in the early hours of this morning saying that the Pentagon is asking the defense contractors to double or even quadruple in some cases their manufacturing of missiles. They say the stockpile is too low should there be a potential conflict with China. John?
Danny, thank you. Appreciate it. Thank you very much. 3 of the single names and more to look out for going into the opening bell in about an hour from now. 10 is the economy. We're waiting for payrolls on Friday and wondering if we'll even get the jobs report. Joining us now to discuss is Bloomberg's Enda Curran. Enda, welcome to the programme, sir. I think we've got to address the elephant in the room. Before we talk about all this, what it means for the Federal Reserve, the data this week, will we even get the jobs report on Friday?
Well, that's the critical question now, the big unknown, Jonathan. If the government shuts down tomorrow night, in truth, most economists think it's unlikely that they would be reopened, a deal would be reached in time for Friday for the data to be released. So there is now a question mark over whether or not we do get the jobs data Friday due to the government shutdown negotiations. Bigger picture then, that doesn't just mean a delay for the September data, it feeds into the whole narrative and story around the quality of the jobs data and broader data anyway, when there are enough questions and doubts already circulating in the market about that. And then throw into the mix, of course, what does it mean for other highly sensitive data readings like inflation numbers, the gathering and collection and eventual release of all of that. So a lot will depend, of course, if the government does shut down, then how long the government does shut down for. But at the very least, big question mark now over whether we get the jobs data or not.
So, Enda, as Lisa identified a little bit earlier, we have to basically refer on some of the private indicators that we get. ADP, we'll be looking out for the ISMs as well later this week. Enda, what kind of a picture do you have for the economy at the moment? And just how divided is the Federal Reserve? We were talking about it just months ago. It just feels like, at the moment, differences are getting wider, not narrower, on the FOMC.
It doesn't seem to be a binary story on either the economy or the FOMC, Jonathan, right now, like you mentioned. I mean, on the one hand, of course, we've had this big shift in the jobs data. Clearly, labour market weaker than expected. The Fed, of course, putting all focus on that now. It's kind of a consistent thread there. But, you know, we also had much stronger than expected third quarter growth. Consumer spending on the retail side still holding up pretty well. We'll get consumer confidence this week. That's expected to show kind of a rebound in the month of September. So you have this kind of picture where the economy is still holding up even as the jobs market weakens. Now, of course, if we were to get that data at the end of the week, it's expected to show around 50,000 odd jobs created last month. But there would be a lot of scrutiny in terms of where those jobs being made and lost, and in particular the manufacturing sector, politically hot. Is that turning around? Any signs of a turnaround there? Are we seeing any signs of the federal job cuts starting to leak through to the jobs data yet? So, as I mentioned, headline growth, aggregate data on the economy okay, but the underlying jobs numbers are expected to continue softening for sure.
Emma, thank you, sir. Appreciate it. And with the latest down in Washington, D.C., got a wide spread of opinions on the FOMC right now. So that means someone could be very right and someone could be very, very wrong at the Federal Reserve. And someone on this committee, many, could be caught really offside into 26.
You know, the big question, I think, for markets is what Manny Roman was talking about of PIMCO, how much you have faith in the members to ultimately be swayed by the data that comes in because they don't know that much more than the market knows. And ultimately, if there is a hot print, what inflation print in particular, how much do they respond to that with either stopping some of the rate cuts or even possibly putting a rate hike on the table? That is the unknown, especially given what Stephen Myron was talking about, which is targeting a neutral rate that he sees as lower and expecting the data to follow suit.
That's the bear case. 22, you go into 22 and you're thinking inflation's transitory, and then you get absolutely hammered by rate hikes and a Federal Reserve that has to pivot. You go into 26, worried about downside risk to the labour market. You're talking about inflation as if it's transitory. Do you get hammered by a Fed that has to pivot again? That's the bearish case. How credible it is right now with other people, I don't know, but ultimately that's the story.
And will the Fed be willing to do that? Right. I mean, ultimately, right now, this is not a market that believes that the independence of the Fed has been compromised. You can see that in the inflation break-evens. You can see that in a whole host of other metrics. If that gets to be the case, then all of a sudden you have a different story. And I think that that is the test. What happens and what is the reaction function when you do get an inflation print that comes in hot?
Let's talk to someone about it. Lindsay Piegza of Stifel joins us now for more. Lindsay, welcome to the programme. You've criticised the Fed in the past for stopping short of being sufficiently restrictive. You think they eased too early last year as well. What mistake are they making now?
I think they're doing another round of precautionary easing in anticipation of this weakness, this fear of weakness in the labor market, rather than focusing on the problem that's right in front of them, which is still too elevated inflation, as it has been for years now. So I am concerned that the focus is beginning to shift away from inflation just at a time when the risks to inflation remain to the upside. As we look towards the end of the year, we could see hotter price pressures amid a stronger growth profile, a more spendy consumer as we move into that key holiday spending season, or as we turn the corner into next year and corporations find they need to pass along more of these cost increases onto the consumer that were previously absorbed into the bottom line. So right now, I think the Fed would be well advised to take a very cautious, patient approach, watching the data as it evolves and respond to the data, as opposed to anticipatory, reactionary easing as they have been for fear of, again, that labor market weakness.
Neil Dutta over at RedMac has been throwing things at the computer screen, or however he watches this show, as he listens to this, and he says, ultimately, how much can you have a reacceleration without the participation of the housing market? You can look at all of these metrics and raise questions about it, but because housing is flat on its back and is actually contributing to disinflation, isn't that an argument to sort of squelch some of the inflation worriers?
I don't know if we can make that specific argument and isolate it to that degree. Right now, we're looking at the consumer data. Consumer is the backbone of the economy. So independent of housing, if the consumer is out in the marketplace spending on goods and services, because there still is a good amount of spending and borrowing power on part of the household balance sheet, I think we can continue to see at least these 2%-ish growth rates for quite some time, which will continue to perpetuate this still elevated inflation. So again, it goes back to the fact that the Fed did not do their job the first time around. They compounded that mistake, that policy mistake, by easing last year. Now it appears that they're willing to do a third round error with that September rate cut, and still a number of Fed officials talking about additional easing by this time next year.
So, Lindsay, why do you think the yield curve is flattening?
Well, I think right now the market is buying into the notion that the Fed will provide easier policy. And the Fed seems to be, or excuse me, the market seems to be focused on other issues than inflation. But that's not the only metric of what we're seeing in terms of investors' concerns. When we look at inflation expectations, we see that near-term inflation expectations are still up near 5%. Longer-term inflation expectations up up near 4%. So even with the Fed continuing to reiterate a focus on reinstating price stability, the market isn't buying it. Now, the yield curve, yes, we have seen a lot of volatility, but a longer base trend should continue to provide a floor to longer-term rates, given those inflation expectations, not to mention the massive expansion of the balance sheet.
And yet, Lindsay, that's not constraining the Federal Reserve. In fact, they continue to signal interest rate reductions. Now, you and I have played this game a million times. We can complain about what the Fed should and shouldn't do. It's the will-won't that really matters to financial markets. What do you think they will do?
Well, I think right now, when you look at these varying opinions of the Federal Reserve officials, I think they are going to, at least in the near term, stay pat. They gave us that insurance rate cut in September earlier this month. But when we look out to the end of the year, unless we see a material decline, further decline in some of those jobs numbers justifying additional policy adjustments, I think the Fed is going to have to stay steady where we are. Now, that being said, the inflation hawks, they're looking for policy to maybe even move firmer unless we see a material uptick in inflation, not just a temporary few tenths of a percentage point, but a sustained upward trend in inflation. I think it's going to be difficult to justify a rate hike on the other side. So I think right now the Fed is more in a position to let's hold steady, watch the data, and both of the sides, the doves and the hawks, can fight it out over what we see the data evolve into.
Lindsay, appreciate it. Lindsay Piegza there of Stifel with the latest. I think those doves and those hawks will continue to fight it out next month.
Yeah, I wonder what that fight looks like. Very polite. I don't agree with you.
I'd say Governor Myron actually was pretty diplomatic when we asked him, wasn't he? About his experience going into the committee, the need to persuade people, how open they were to his views.
I think he was being honest. I don't think anyone gave him odd looks or refused to sit next to him. And I think people were actually welcoming contrarian views that they could push back on. It was clear that nobody was particularly convinced, but he is representing something that people on Wall Street are talking about. The big difference, and he talked about this in his conversation with us, is just the speed. How quickly do you need to get to the ultimate destination for the Federal Reserve? And that really is based on what you see in the economy and what you see evolving.
What you think neutral is.
Exactly.
That debate's ongoing because no one really knows what neutral is. Someone else joked about this, it's not my line, but they thought it was pretty curious that people were insulting Governor Myron about where he thinks neutral is because neutral can't be observed, and they keep saying that things are okay as they are because we're close to neutral, but neutral can't be observed. It's a very circular argument where you find yourself in a tricky position when you criticise others.
Who's on first? Who's on first? I mean, this whole thing, it's a very difficult moment, especially when you're talking about these theoretical concepts that don't really exist.
You can't observe any of this. Apart from in real time, you can say, you know, yeah, we're neither sort of, whatever. Bond yield to lower by 2 basis points, 4.15 on a 10-year this morning. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Video game maker Electronic Arts is going private. The deal values the company at $55 billion. That's the largest leveraged buyout on record. The consortium, which includes Silver Lake Management, Saudi Arabia's Public Investment Fund, and Jared Kushner's affinity partners, agreed to pay $210 per share in cash. Shares are higher, 5.3%. Meanwhile, President Trump is warning the government is likely to shut down unless Democrats ease their demands. Senate Minority Leader Chuck Schumer says a stopgap has to include an extension of health care subsidies. The president is set to meet with the top 4 congressional leaders at the White House today, just one day before federal funding runs out. And New York City Mayor Eric Adams has ended his re-election bid. The announcement follows reports that Adams was entertaining potential job offers from the Trump administration and the private sector. That's in exchange for bowing out of the race to allow former New York Governor Andrew Cuomo to challenge Democratic nominee Zohran Mamdani. That's Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Thanks very much for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Jim Karen of Morgan Stanley. Looking forward to that conversation on why the money will have to stay easy for longer than you think and what it means for asset prices. Jim's up next.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the most fascinating time for the global economy in years, and our conversations are front and centre.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The big tech companies are just keep ratcheting, the expectations just keep ratcheting higher and higher. These are not stories where valuations are going up because investors are exuberant. The investor class keeps underestimating how good the earnings picture is. Earnings are driving the superior results.
Good to catch up again with Jonathan Golub of Seaport Global. Constructive on the earnings story in the equity market. Equity futures so far this morning up by 0.5% on the S&P, higher by 0.7% on the Nasdaq 100. As we count you down to the opening bell, a few things to look out for later on this afternoon and through the trading week. Today at 3 p.m. Eastern Time, the President meeting with congressional leaders. Look out for that because tomorrow, government funding runs out. Then on Wednesday, PMI and ADP data, the data points to look out for. ISM's in the mix too going through the week. On Thursday, another round of claims. And on Friday, maybe the payrolls report. We'll see if we get that. The payrolls report is due on Friday. Let's turn to fixed income. Treasury yields ended the week at their highest levels in a month as investors shift focus to Friday's jobs report. Joining us now to discuss is Jim Caron of Morgan Stanley. Jim, good morning.
Good morning.
We just had the biggest leverage buyout deal in history announced earlier on this morning. And in your note, you said this: there is something deeper at work that may keep easy policy at work for longer. There's a lot of money sloshing around, and you think money can stay easy for longer. Why is that?
Yeah, thank you. Look, I think there are a couple of other things at work here, right? So let's talk about monetary policy and fiscal policy. Those are the two policies I'm looking at. On a monetary policy perspective, the one thing that's happening is that as the balance sheet is shrinking, that is effectively a tightening of policy that's creating some potential for liquidity issues in the markets. That's measured by overnight repo rates, which have been going up, which is a sign that bank reserves have been under a little bit of pressure. So the Fed may not just be cutting interest rates to have an insurance cut for the jobs market, but it could also be there to try to stave off any type of liquidity issues. The second point is on fiscal policy. Fiscal policy, I believe there's a geopolitical need or desire to have coercive policy between whether it's tariffs or a strong economy driven by tariff-related policy in order to fund fiscal and geopolitical, policies throughout the U.S. in terms of what their objectives are. So my bottom line here is that there are other things at work on the geopolitical side and on the balance sheet side that could keep the policymakers at it for longer, despite what the economic numbers are telling us.
Can you have your cake and eat it too? This idea that everything is easing, you're going to just have an extra boost to markets. It doesn't seem like people are worried about inflation. Where's the rub?
That's the rub, it's inflation. As long as you don't get inflation, then you can keep doing this for a bit longer. But eventually, obviously, these things come to an end. So what is happening right now as far as some of this fiscal policy, this is tax policy, accelerated depreciation, this is all in the One Big Beautiful Bill Act and what have you. What that's likely to do is generate higher productivity, which means you can have higher growth with lower inflationary burdens. Your typical way of thinking about the economy is that you get stronger growth, and that leads to higher inflation. But what's happening is that the unemployment rate is staying relatively low, but there's fear that it may actually start to come up. We're seeing that in the numbers. The labor numbers, we're going to see some more on Friday and Wednesday, are actually showing some signs of weakness, which means that you're getting labor at a reasonable price. There's enough. The labor force participation rate has been going up despite almost zero immigration. So people are entering into the workforce. That's keeping labor costs relatively low. If you keep wage inflation down, then you keep consumer inflation down. That can increase profit margins, and that can be supportive for equities broadly.
Another way of putting this is the way that one person framed it to me, is do you need to run the economy incredibly hot in order to make it so that a lot of people don't lose their jobs to AI?
That is the underlying story. That is exactly right. And that will continue to happen until there's high wage inflation that ends up leading to high goods inflation, and then the Fed has to then act and start to tighten policy, which that's not the move that they're doing right now. They're likely to cut rates another 3 times. But that is exactly right. You have to run the economy hotter, and you can as long as you don't get the adverse inflationary impact. So for everybody investing in equity markets and what have you, this is actually a reasonably interesting time, and you can see that in today's futures prices.
Does that depend on who leads the Fed?
I think it does. It does to a degree, but the productivity boost and the boom and the CapEx cycle, a lot of this is really coming from the fiscal policy side. A lot of that's coming from the tax accelerated depreciation and a lot of the tax policies. It does depend on who's leading the Fed. But I don't think that I don't think we're overly reliant on that, because if the inflation numbers come low, their models are pretty hard-coded. They don't have to worry about it.
Even if inflation spikes, I'm just wondering, will we have a willing partner in the Federal Reserve just to let this rip?
Yeah, so if inflation spikes, I think no. I think that everybody will line up, because inflation, whether it's political or it's economical, inflation is something that nobody has any patience for whatsoever. And I think the Fed, even though people might say it's become more political, will pivot on that. Inflation is the one thing everybody feels all the time.
I'm just thinking about Richard Fisher's speech back from the Dallas Fed, where he was talking about beer goggles, where if you're at a party and you're a little bit, had
Tell
a few,
us more, Bramo.
that everything looks good to you. I just wonder how much people are getting ahead of themselves with respect to long-term investments that project out growth over the next 10 years, and we have no clue. We have no clue about a lot of these industries and how they're going to evolve. We have no clue with video game creation and whether people are going to invest so much to play this particular game or that particular game. How do you price this out?
Okay, so I think the best way to do this is to go back in periods of time in history and think about, forward-looking elements to this. What we are going through today is a CapEx cycle. For the last 25 years, we've really had a housing-led economy. Housing is not the big driver of growth and investment right now. It's a very big part of the economy, don't get me wrong. But we are in a CapEx-led cycle. The last time we saw this was about 30 years ago. It was in the mid-1990s. That CapEx-led cycle brings manufacturing, brings higher quality jobs, you get higher productivity, you get more profitability, and what you end up getting is the big one, higher potential growth. That's what a big CapEx cycle does, and I don't think that people fully appreciate that because, it was 25, 30 years ago.
I guess I'm just thinking about this EA deal, which I know you don't want to comment on. But the idea of, The Sims or Call of Duty, and that we can
dance around it.
Put a value around some of these things 10 years out when people aren't playing some of these more expensive games and they're actually on their phones. I mean, how do you understand how much money is going to be lost in this process?
So the way that I think that most people going into any type of an investment deal think about it is they always think about the discount rate. That's why interest rates matter so much. If you believe that interest rates are going to be lower than ordinary in this type of a relative to the amount of growth that we're potentially going to get, And that means you're buying things at a cheaper valuation because you're discounting those cash flows at a lower rate, which gives you a higher present value. So it really depends on your perspective. If you believe in this productivity cycle, this CapEx-led productivity cycle that gives you better growth with less inflation, or at least stable inflation, then you can actually value these companies and these opportunities at a higher valuation. And that gets back to what I was saying before, is that CapEx, higher productivity, supports higher valuations. So what may seem crazy maybe to us or to other people may not be, depending on how you're thinking about it.
Jim, smart. You always make me think, and it's good to catch up. It's good to see you. Thank you, sir.
Thank you. Good to see you.
Jim Karen and Morgan Stanley, thank you very much. And thanks to Lise for explaining what beer goggles are.
Well,
I felt like you were getting into dangerous territory there.
I think I did a really good job.
You did a fantastic job.
Thank you. Thank you.
We're reflecting on the biggest leverage buyout on record. Electronic Arts agreeing to sell to a group of private investors in a deal that values this company at $55 billion. Look, it has been deal after deal after deal.
This is fascinating from so many points of view. First of all, the idea, does this indicate that we really are at a place where some of these deals can get unlocked, and this idea of M&A in the tech sector, also just the easy financial conditions, but also how do you value something? I mean, is Call of Duty even going to be popular in 2 years, or is everyone going to go back to reading books?
I'm not a video game kind of guy.
I think that you are.
And neither are you. So, like, you and I are the worst people to comment on this story. From that dimension, from that angle.
Yeah, but I can advocate books.
True, I can do the same thing. This was a fun start to the week. The fun continues tomorrow. Will we get a payrolls report? From New York, you're watching Bloomberg TV.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
A cidade estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
In case you missed it, on the close.
Sweet Green, which has a kind of a similar business model to Kava, they're having some issues, and it's more about just the foot traffic. Maybe the price points are too high, or people have just moved on to other types of ways to feed themselves. What are you seeing?
We're not seeing anything underneath structurally in the business. If anything, we're seeing greater structural strength. In recent years, we've now underpriced CPI by 900 basis points. So again, our value scores continue to improve. We continue to make our food more accessible and really try and mitigate any of the impacts of, say, tariffs and not have to pass along to our guests.
There's been a lot of talk about how do you reimagine stores like this. What do you want your customer to do?
If you're in a hurry, we've got great digital channels. We've got 60 drive-through pickup windows. But if you want a great physical experience, you can have that walk-the-line experience, see the food, smell the food, interact with our team members. Our mission is to bring heart, health, and humanity to food. So we want to deliver that humanity in the four walls of our restaurants and have a great environment for you to enjoy your Mediterranean meal.
Don't miss The Close, live every weekday.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Jumana Bersachi in Vienna, and this is Bloomberg.
Looking to kick this week off in the green. 30 minutes until the start of trading. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Electronic Arts agrees to go private in a deal that values the company at $55 billion. It's the largest LBO on record.
Gold surges to a new record as a government shutdown looms. U.S. gold reserves surpass $1 trillion in value.
And they're marked right now at about $11 billion. A CEO contender, Citi's head of banking, Vis Raghavan, emerges as a potential successor to Jane Fraser. We'll talk about that.
A lot to talk about. I don't know what this means about where we're in this cycle. The fact we just had a $55 billion leveraged buyout, a take private of Electronic Arts. Matt mentioned it, the biggest leveraged buyout ever. So it puts it at $210 a share. We're not quite there yet, up 5.3%, Matt. My favorite fact to this is the high water mark before was a Texas utility company leveraged buyout in 2007. That eventually went on to go bankrupt.
Very, well, that's a bad sign, but very
Right.
different industry. We're also watching defense stocks. They're moving after a report that the Pentagon is asking missile suppliers to double production rates, a tall task for production of missiles that can take up to 2 years to assemble, Danny. You can see that we're looking at big defense movers throughout the space. And later on in the show, I'm going to ask venture capitalist Tim Draper what he thinks about investing in defense.
Stick around for that conversation happening in about an hour and 45 minutes time. Let's turn back to our top story this morning. The EA deal, the biggest leveraged buyout on record. Let's discuss it with Bloomberg Tech co-host Caroline Hyde. Caroline, it's punchy $55 billion for video game maker.
And not even got Battlefield 6 out yet. This is what they're betting on, future success. Look, this is a company that is all about IP. This is certainly what the CEO is trying to tell its workforce already. He sent out a note to employees. But this is about their strength not only in shooter games, such as Battlefield 6, that comes out October the 10th, but also the sports dynasty really that they're showing, the fact that they're really into soccer but also NHL and the like. This is able to withstand perhaps some of the macro headwinds, some of the offset that, you know, everyone's turned to free-to-play games. Everyone's on Roblox, everyone's using Fortnite. How have these studios been able to withstand that? This leveraged buyout comes at an idea that Silver Lake, but closely focused on some of the PIF funds, the Saudi money. They are experienced when it comes to gaming. They understand what it's necessary. And basically, this is a company that wants to come out of the eye of the storm when it comes to quarterly reporting and just get down and start being a bit more creative, a little bit more innovative without having to report on a quarterly number. But the numbers are eye-popping. If you're thinking about this from versus EBITDA, this premium is huge in comparison to, say, what an Activision was bought for by Microsoft.
I never thought being a fan of first-person shooters would make me feel old, right? But I guess the kids aren't really into that anymore. All right, so what do we know about the details? Who's behind this LBO? Which banks are financing it? Danny already gave us a share price, I think $210 a piece, right?
Exactly, and maybe there could be others that would come into play. Maybe feeling if Battlefield 6 does end up being a roaring success, you could have some competing offers here. But clearly the board has recommended this particular offer, $210 per share, as we know. Silver Lake Management, which we keep talking about at the moment because they're obviously one of the players within TikTok, they're looking to be involved, as is Saudi Arabia's, as I mentioned, public investment fund. Interestingly, of course, Jared Kushner's Affinity Partners, which has also got money from the Middle East, he's looking to be a player. Of course, close relationship with the president, so maybe that eases some or any regulatory concerns that might be coming to play with foreign ownership. But then you've also got the idea that JP Morgan's going to be here helping with the facility in terms of the debt load here. And this is going to be an enormous amount of debt that they're going to be taking on, but this is one that people are desperate to get in on. You know, just think about Oracle's bond sale at the moment. People want to be able to buy in on these sorts of debt mounds. We're seeing about this LBO more broadly that this is a willingness to get in to yield more and different types of asset classes. So I think JP Morgan's the main bank behind this.
It speaks to just how much money is in the system right now.
Yes.
But Caroline, elsewhere, it's been a really good month for tech, despite some of the headwinds coming out. We had another one, some excellent reporting from the team that Huawei is going to double their chip output, obviously trying to have a direct threat to NVIDIA. Yeah. It's not a new story, but how is it evoluting?
Well, the evolution here is really about getting the cadence at which they're going to be able to manufacture. They're trying to persuade the market. More broadly, they're trying to persuade Alibaba, Tencent, and those that have depended on at least 1 million GPUs, H20s, coming from NVIDIA in 2025. They're saying, look, we're going to ramp up, we're going to double in 2026. We've got you. All those bottlenecks that you're seeing, all the concerns that basically they can't really manufacture these sophisticated chips in China at the rapid scale that, say, an NVIDIA can or a TSMC can, because SMIC and the others that they depend on, it's really hard to manufacture these sorts of chips. They haven't got as powerful individual chips. I think Bernstein out there saying the next iteration of the Ascend is going to be only about 6% in terms of power versus the new GPU coming out from NVIDIA. So what they have to do is have very innovative way of basically casing it. And this is then coming to more broadly then how you manufacture that, what sort of hit rate you get. And basically you don't make as many good chips each time that you're iterating. And so they have to bake in the fact that a lot of them aren't going to work as they are meant to. But Ascend is meant to be coming on tap. We've got 1.6 million maybe being promised for the next year. So this is a big scale up coming from Huawei, and actually being far more public in their disclosures than we've ever seen before. So really trying to show Eddie Zhu that I've got you here, China. We can be there for the supply chain.
All right, it is a fascinating rivalry that's shaping up there. Caroline Hyde co-anchors Bloomberg Tech. That airs at 11 o'clock with Ed Ludlow, and they'll be covering all of these stories and more at that point. I want to get, though, to a very old and untech story. Gold is worth well over $3,800 a troy ounce, and that, by the way, values our United States of America gold reserves at over $1 trillion if we were to mark them to market. The interesting thing is that they're marked at like $42 an ounce, so only $11 billion in total. Let's talk about that with Bloomberg Managing Editor for Commodities, Simon Casey. I love a good gold bug and a conspiracy theory and like the idea that we could, like if we marked these reserves to market, Treasury could have another $990 billion.
Yeah, click of the fingers. Not as simple as that, unfortunately. It would require legislation through Congress. It's a rather controversial idea, to say the least, a bit of a fringe idea. It gained traction, if you remember, back in February, in the early days of Trump's inauguration, following the weeks that followed, and lots of ideas being put around how to fix the nation's finances. It's still a fringe idea. Scott Bessent triggered a lot of speculation back in February. I think he talked about looking at various ways to re-engineer the U.S. balance sheet.
He wanted to monetize the asset side.
That was the phrase, right. He walked back those comments a little bit in the face of a lot of speculation about from the gold bugs. The gold bugs are always there.
I'm so upset we haven't gone into Fort Knox and done an audit of the gold.
Yeah, is it even
that
there?
Never happened. Is it even there? I'm into the conspiracy theories. We got to go in there, Simon.
Well, yeah, I'll be right there with you. I mean, this is something that Trump sort of fueled a few months ago as well. I think he put out a tweet saying we should go there and find out. I mean, I think it's there. It'd be a big story.
That would be a huge story if it wasn't there. Elsewhere, just in the gold sector and in gold miners, a lot of different C-suite moves between Newmont and Barrick. I'm guessing they're not related, but what's going on there?
Well, the Newmont thing seems very orderly. It's a retirement, an internal promotion, sort of succession planning going on. The really interesting one is Barrick. Mark Bristow, he's been there for 7 years. He's a rare case of a CEO who was acquired along with his company, and he rose to the top spot as a result of that merger. He's a very, very well-known character inside the mining industry, very vociferous. He's been on Bloomberg TV many times, talking often very critically about the industry and how it doesn't always capture the value from gold. This is a bit of an abrupt announcement. His replacement is on an interim basis, an internal promotion, but the company's also saying they're running a full process with a recruitment firm, a headhunting firm. So who knows who the final full-time appointment will be? But that's a bit of a shock, that one. And coming on the same day, we have record gold prices, of course.
Yeah, I mean, up what 80% over the last 12 months. I'm looking at a chart here, and if you look at Barrick, it's only up like 50% in over 5 years. Newmont also isn't doing great, but their competitors have doubled, tripled, even quadrupled.
Yeah. Some of these bigger companies have run into big operational problems, particularly with Barrick. They've got a very serious issue in Mali, where the junta there has tried to seize control of this massive mining complex. They've imprisoned some of their employees. So Barrick's been dealing with that. But mining is a difficult business, but as you point out, the last several years, the equities just have not kept pace with the metal. So it really calls into question the fundamental case of why would you want to buy these shares when you could just buy an ETF, buy the physical gold itself.
And people surely have. Simon, thank you so much for joining us. That's Bloomberg's Simon Casey. All right, we're 20 minutes from the cash equity open. Futures look to rebound after the first down week last week in about a month. By the way, this is the S&P 500's best September since 2013. And we started this month. How did we start it? Basically saying September is usually horrible.
Yeah, we showed the heat map and we were like, oh, over the last 20 years, you know, it's been one of the worst months, if not the worst month. Yeah.
And everyone was like, summer's over. Everyone's back at their desk. There's so many risks between tariffs and the Fed. By the way, all those risks still exist, but we keep pushing things higher to new records.
And we're going to some really positive seasonality. Like October and November are traditionally good months. So, you know, take that for whatever it's worth. Coming up, Citi's investment banking head has emerged as a candidate to lead the bank after Jane Fraser has her turn. More on that next. This is Bloomberg Open Interest.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Let's get now to high interest. Look what's making headlines around the world. Chinese President Xi Jinping is pushing for the U.S. to change a decades-old phrase describing its stance on Taiwan independence. Sources tell Bloomberg China has asked the Trump administration to officially declare that it opposes Taiwanese independence. Stronger language than the previous statement that the U.S. officials do not support Taiwan's independence. It's a subtle but huge difference. Let's get to company news. AstraZeneca plans to list regular shares on the New York Stock Exchange to attract more investors. A direct listing of Astra's ordinary shares will replace the existing ADRs on the NASDAQ. AstraZeneca is the biggest drug maker in the UK, makes almost half of its revenue, though, here in the US. It does plan to keep its UK headquarters, but who wants to list in London? Citi investment banking head Viz Raghavan has emerged as a potential candidate to succeed the current CEO, Jane Fraser. Raghavan has energized the division since his arrival last year, with the bank scaling the M&A advisory ranking and displacing rivals on recent deals. And this is something I think that a lot of investors and also probably viewers who work at Citi are very interested in, Danny.
Definitely, assuming the ones on his floor are currently watching. Let's stay on that story and bring in Bloomberg's chief Wall Street correspondent, Sri Natarajan. Sri, it's also interesting that this is an individual who came from JP Morgan as well, somewhere that's had maybe some issue keeping top talent because of succession planning. What do we know about him and the likelihood that he would be a successor to Jane Fraser?
Well, let's start with the three most important factoids about him. Vizraghavan is a cricket fanatic, which puts him high up in my list.
Of course, a necessary quality.
Has a fondness for Italian ties and has purchased a penthouse in New York that was previously rented by Bad Bunny. So let's get those three important facts out of the way. Now, Vizraghavan has come to Citigroup at a very important moment. The bank has been struggling. End of 2023 was perhaps the low point of Citigroup. Shortly after that, CEO Jane Fraser had to come out and announce this massive restructuring that involved cutting 20,000 jobs. But about 2 years into this process, there are clear signs of turnaround. Citigroup is the best performing big US bank stock this year. That's important. Even on the investment banking side, the very particular mandate that Vizraghavan has shown signs of improvement. It has already gone ahead of Bank of America for the full year numbers. If you were to look at financial advisory fee, analysts are estimating that Citigroup will finish number 4. But really, this is not about the number 4 and number 5 spot. For Vizraghavan to be really successful, he has to be able to prove to Citi's management, to its board, to its CEO, that he can lift this bank into the top 3. And that's going to be a very difficult challenge because the Goldman Sachs, JP Morgan, and Morgan Stanley, that trio has a really solid advantage. So the task ahead is difficult, but there have been early signs that sound very promising for Citigroup.
What works to Citi's advantage? I mean, they must be one of the most international banks out there.
They are one of the most international banks. They're, of course, paring back some of what they believe are not core to them, operations that are not core to their mission, cutting back on some of their international banking operations per se, but focusing more on the commercial banking side, right? Focusing on this wealth management and commercial investment bank side and saying, if we can focus on this, lift our return on equities, which, you know, for this year perhaps is still in the single digits. They need to be much better than that, but they're slowly working towards that. And if Jane Fraser's turnaround continues on this track, analysts will be happy with where they are headed, not necessarily where they are right now.
Can I ask you just about like succession planning? One of the things I never fully understand is you have this person coming in who's done a great job for the bank and saying maybe a potential successor to Jane Fraser. I think they're literally the same exact age. So how would that work if you have two people who are, or a person who's a rising star, but she's not necessarily going to leave anytime soon?
I'll one-up you on that. Not just almost literally the same age. I think Vizraghavan is about 6 months older than Jane Fraser. So most certainly the biological clock is not favoring him. Also, don't forget the fact that Jane Fraser is about 4 years into her tenure as the CEO. And while the average tenure on the S&P 500 tends to be about 6 to 7 to 8 years for CEOs, that's not necessarily the case in the banking world, especially when the CEOs had a good run. So if Jane Fraser can continue this Citigroup turnaround story, there is no reason she would have to leave in the next year or 2 or 3. And if that's the case, then yes, it becomes harder to see how a Vizraghavan becomes the next CEO. The counterpoint to that is 60 is the new 50.
Right. Well, and she still is underperforming Jane Fraser. I mean, there's no bank on Wall Street that's done worse over the past 5 years other than Bank America.
And to that, she will say there's no bank on Wall Street that's done better than Citigroup in the last year, and that's important.
Well, 1 year, right? I'd take a longer term. As an investor, I would take a longer term view, probably as an employee as well.
So see where the story is headed, not where it is right now, is what Citigroup is going to tell you.
All right, Sri Natarajan, go where the puck is going. He is Bloomberg's chief Wall Street correspondent covering this story for us. So get a quick check on futures ahead of the opening bell. We're looking at gains across the board, 0.5% on the S&P 500, and we're getting results in terms of earnings. And, you know, you and I were in the green room earlier, Danny, for surveillance and talking to a couple of strategists, talking with Max, talking with Jonathan, and they were saying it's really all about earnings, right? And we have great earnings news out from Carnival, raising their full-year outlook.
Yeah, they're raising their full-year outlook better than the guide that was in June by $235 million. Shares are up, you can see, nearly 4%. Cruise keeps surprising to the upside, though. This is one part of the consumer economy that still has been so strong, but how much of it is just about, okay, consumers are happy, they want to keep traveling, versus the cruise lines really trying to shift to luxury and capturing the upper income cohort that is making these results continue to be strong?
Is that what's happening? I mean, if you're a rich person, do you go on a Carnival cruise? I mean, I guess the results point to some of that at least happening, and we do see the shares up 4%. Next hour, we're going to hear from Norwegian Cruise Line CEO Harry Sommer. We'll ask him if that's the case.
They've been
as
adding
well
to their luxury offerings. They have. They have a new maiden voyage ship happening that is a luxury ship by
That's right.
all accounts.
He's going to ring the opening bell at the New York Stock
Very
Exchange
exciting
as
stuff.
well, so investors will notice. We're also going to get RBC's Lori Calvasina on the high bar for earnings as Goldman strategists turn bullish on stocks globally. This is Bloomberg Open Interest.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Goldman Sachs strategists are telling clients to buy the dip through the end of the year. The team is overweight on stocks over a 3-month horizon, citing earnings growth and global fiscal policy easing. Earlier this month, Goldman raised its year-end S&P 500 price target to 6,800. Joining us now is RBC head of U.S. equity strategy, Lori Calvasina. And Lori, I mean, you have maybe been more reserved, not bearish by any means, but more reserved in some of the stuff that you have been seeing. We're about to book the best September since 2013, after we came in saying that the seasonality was horrible. Can you keep buying dips, or is it just about staying where you are?
I think this is a really weird market. You know, I don't necessarily disagree with the buy the dip strategy. We actually put out a target of 7,100 for the second half of 2026, really just to kind of flag how our models are trending for next year. Some of our models are on a 12-month forward basis, so it's not quite a year-end target. But I do think that we've got a good earnings setup for next year. I think there's, you know, a little bit of an issue on valuation in the here and now. And what I talked about a lot last week in my meetings, I was in the UK, and frankly, a lot of people over there are a bit more reserved than what we're seeing in the US.
What I've noticed is that when I look at my PE charts and, just the last month and a half or so, we're creeping up to these new highs on the S&P, but I'm not seeing any multiple expansion. And so it looks like whether you're looking at S&P top 10, S&P 500 market cap weighted, NASDAQ 100, pick your own adventure. You can do equal weighted or cap weighted there. They're not making new highs. They're up around levels that have marked the most recent post-tech bubble ceiling, and they're unable to break through. And so I think that's why when I see this market, it feels like it's creeping up to new highs, not exploding to new highs, even though everyone's getting excited about the price levels.
So we essentially need to have a continued earnings expansion in order to have price appreciation. I'm also interested in, I was listening to you with Nathan Hager this morning on Bloomberg Radio, and you've done some work on inflation, because we're starting to realize that 3% is really what the central bank is focused on, right? They talk a big game about 2%, but they never, ever, ever go down there. So do we see gold breaking out to new highs? Do we buy equities as well to counter inflation?
So, the reason I sort of got focused on that, it was sort of like mid to late August. I'd been talking to Chris Looney, who's our gold strategist. We were sort of comparing notes on kind of what's driving his market versus what's driving mine. And that was right when we were starting to see all the euphoria on small caps start to break out. And I thought back to my early small cap days where I remember people used to say small caps are inflationary. And so I did this.
Or an inflation hedge.
Yeah. And basically, small caps were kind of born in the 70s. That was when it was a really hot asset class. And then that was really, sort of inflation was obviously a major issue back then. So I dusted off a bunch of charts, built some new ones, just looking at things like equity allocation on the flow of funds data. They call it something now besides flow of funds, apparently, but looking at that data set and comparing it to inflation rates over time. And it's kind of broken down in recent years, but you could see that equity allocations would go up when inflation was moving up. And then I did some work on small cap. I think I looked at ISM prices paid, which my economists tell me is a good leading indicator for goods inflation. And you had seen some relationships there as well between small cap performance and just that particular inflation indicator. And there had been some we had used in the past. But again, a lot of these have broken down in recent years. So we wondered if part of what was going on in August was, kind of people, frankly, looking, for clues on what to do, trying to make sense of this inflation environment and kind of having some of that past history influence decision-making.
All right. Fascinating stuff. Lori, we're going to keep you with us. Lori Calvasina from RBC is going to stay with us through the market open as futures point higher. This is Bloomberg.
Asia's not sitting around waiting for politics to dictate what's important here. It has already been a leader and is continuing to be so.
People come to me and say, well, Trump's been, sort of saying, well, we shouldn't be focused on this, but yet the corporate world knows that it needs to support this.
Asia's role in global supply chain allows it to influence the transition in ways that many other regions cannot.
All the companies that I've been talking to they have not stopped the work of looking through their supply chains with ESG in mind, because that is just where the puck is going.
Our focus is really to understand what are the technologies that are part of our portfolio for the future and scaling those technologies so that we can meet our demand with clean energy.
Resiliency is just not an operational response to what is happening out there. Resiliency could and will be a strategic advantage that companies we'll start to look at.
There is still hope to actually get back down to something of a livable world if we get our act together.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on futures. We're higher across the board. It's not a new month yet, but October does look good seasonally. We're almost there. S&P futures up 1/3%, a little bit more than that. NASDAQ futures up 0.5%, and Russell futures gaining even more. We're excited, more excited than usual about the New York Stock Exchange bell ringing ceremony today because Harry Sommer is ringing the bell, CEO of Norwegian Cruise Lines, and he's going to be on with us in 1 hour's time. So definitely want to join for that after Carnival Cruises had some great results. Norwegian hasn't done as well as Royal Caribbean or Carnival in terms of stock performance, but they have a new ship apparently coming in, and we're going to take a look at that and talk about the luxury aspect of the business. ArcBest ringing the bell down at the NASDAQ. That stock, those people are happy because it's more than doubled as well over the last 5 years, so they're making money. And Danny, it looks like defense companies also are doing well this morning. What are you watching?
Yeah, I'm watching basically all of the defense stocks this morning. They're all moving to the upside. There's a report from the Wall Street Journal that the Pentagon is asking all of its missile suppliers to double, even quadruple production rates in some cases. It's a really tall task considering that doing that takes a lot of time, up to 2 years to assemble, and a lot of money. It's not clear that these companies have the commitment from the Pentagon for that money, Matt, but on the assumption they will, we're up by as much as 2.5% for RTX.
All right, we're talking also today about the largest LBO in the history of the universe. Game maker Electronic Arts is going private in a leveraged buyout at $210 a share. That is, what, is it a $50 billion? The big
55.
number. $55 billion LBO, the biggest video game deal since Microsoft bought Activision, and as we've been talking about, the biggest LBO. We are back with RBC head of U.S. equity strategy, Lori Calvasina, and there's so much going on that I don't think we need to talk to you about LBOs. I want to know about the government shutdown. We haven't really mentioned it much, but aren't we all assuming this is going to happen? I mean, nobody seems to care on either side of the aisle. So does that matter for stocks?
Look, I think that the unfortunate reality is, and I've been doing this in some form or another for over 25 years, and whenever this stuff comes up, you go back and you look at the history and you realize that a lot of these shutdowns, while there have been a few that have been lengthy, most of these, and I actually updated my analysis this weekend, redid some of my work on this.
This is what Lori Calvasina does on the weekend.
I'll be honest with you, I got very little sleep Saturday night. Part was jet lag and part I just decided I needed to rebuild all this stuff. But there's a lot of 1 days and 3 days on the page, and so you realize a lot of these things are pretty fleeting. The other thing is, if you go and look at the performance of stocks on the days in which the government is actually shut, there's a lot of it's kind of mixed and mild. So back in the 70s, we tended to see declines. More recently, we've seen a lot of green on the chart, but the percentage gains are not very big. Now, you can go back, and I actually did this Saturday night, and kind of break out. Oh my God, I sound like the biggest nerd, but you go back and you can sort of look at the different decades, and we plotted the different shutdowns, and you can see in the 70s, these shutdowns would happen in the middle of these really nasty market declines. Fast forward to the 80s, you have to look really, really hard to find the market dips, and they're all 1.5% to 4.5%. And then we didn't really have any in the 2000s. We had a couple in the 90s, and they look completely different. So as someone who's supposed to forecast markets and go out and tell people do X, Y, and Z because of this event, it's every decade is completely different, kind of choose your own adventure. And this decade, frankly, just seems to be very, very different.
A wild Saturday night, Lori. Just an absolutely crazy Saturday night.
The idea is that gridlock is good, right? But that's the ultimate gridlock if the government shut down.
Wait, but is this time different, though? Bob Elliott has been talking about this because this time you have a president who's saying we're going to lay off hundreds of federal workers if we shut down.
Essentially fire
everyone.
Yeah.
So there could be a bigger economic impact this time, maybe impacts markets more?
Well, look, I think one of the things we learned from the spring, right, with sort of the whole Doge effort was that this idea that, government jobs are going to be this tailwind to the labor market, like we've had plenty of time to digest the reality that that's just not in place anymore, right? So this could be episodic. But I do think, right, we're all sort of on tenterhooks looking at the labor market data anyway, right? So maybe, yes, maybe there's a little bit more relevance on that front, but I think this is an issue we're already quite focused on. I do think that, you always want to be careful of just taking the past and say it's going to automatically work this time around. But I will tell you, I'm worked up about, the possibility of a pullback at the end of this year, between now and year end. And even I have a hard time, sort of getting too nervous about this particular one.
I want to ask about something completely different, and that is Danny's been telling me for weeks about the lack of supply of stocks in public markets, and it takes so long for anything to get through this thick skull of mine. But I actually saw Shonali Bassick, now at ICAP, tweeting out the same thing over the weekend. How much does that dearth of supply drive up the price in general? Like, is 25 not a very high PE, considering the fact that we only have, what, half the stocks that we had in the 90s?
Since the late 90s, yeah.
Yeah, look, I kind of, from an S&P 500 perspective, I kind of fade this issue. I mean, the fact is multiples are hitting ceilings that have been important ceilings in the past, and even the recent high on valuation isn't that far below the tech bubble high, at least on the particular metrics that we use. And the S&P 500 has plenty of supply. Like, I don't think that, we're struggling to find companies, right? You can always pull some of the smaller or medium-sized stuff up. Where the lack of supply, I think, has been really relevant in my day-to-day is talking to my small-cap portfolio managers. Because remember, I'm an old small-cap strategist. And we don't do this work anymore, but in the past, we used to do a lot of work on, sort of crowded positions in long-only small and mid-cap funds. And it was a really funny exercise because I would take the list of the top 25 names and show them to the small-cap PMs, and they would be horrified because you talk to a growth guy who owns 17 out of the 25 names, and he's like, but I'm a stock picker, and I like to differentiate. And the reality is that when you have a lack of supply in that part of the market, it causes crowding. So I think that it could be, a contributing factor to sort of those crowding dynamics, certain stocks getting more elevated, people having to tolerate valuations they don't want to in the small cap space. I don't really see that being a problem in the big cap space.
Well, we did have a huge big cap take private. Matt was talking about it and didn't want to ask you about LBOs, but I do, because it is the largest leveraged buyout. $55 billion, JP Morgan supplying $20 billion in debt for this. There's so much appetite for debt financing for these big type of deals. What does it say about where we are at the cycle? At the same time that we're having a discussion about the Fed cutting, there's so much liquidity for this type of public market deal.
Well, I think what's interesting to me is everyone was going bonkers about the idea that like M&A and all this deal activity was going to pick up this year, and we haven't really seen it for one reason or another. So, when we do sort of see transactions coming in, I kind of think about it from that perspective. Are certain things not getting done, so markets are sort of shifting to other things.
Okay, Lori, this has been so excellent. Thank you for joining us. You have to join us again after one of your crazy Saturday nights to tell us what you come up with next.
Crunching data.
RBC's Lori Calvasina. Let's get you a check on equity markets about 8 minutes into your trading day. And we are moving higher this morning by about 1/3%. That follows the first down week for this market in about a month, but we are set for the best September since 2013. NVIDIA leading us higher, despite the fact we had a story early this morning from the tech team at Bloomberg saying Huawei is looking at doubling its output of AI chips. That seemingly not threatening NVIDIA. It's NVIDIA, Broadcom, Tesla, Meta, Alphabet. Goes this whole story of should we have a different Mag 7 that includes something like Broadcom. To the downside, what's leading us down is Apple down about 0.75%. Intel down a punchy 4.4%, but that comes after a huge run last week. Exxon, a lot of the energy players down with oil prices down this morning. You'll also see that on our sector board, the fact oil is down more than 1%. OPEC looking at pushing up their output. So there you go, energy at the bottom of the pile, down 1.3%. What's at the highest? I showed you NVIDIA, so of course Infotech, that is at the highest at 0.8%, followed by industrials and consumer discretionary, Matt.
All right, coming up, sluggish growth is forcing video game studios to consolidate or go private. We've been talking about the EALBO. We'll discuss that with gamer and Bloomberg Tech co-host Ed Ludlow next. This is Open Interest.
At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet on the other hand, if you're stubborn and you refuse to admit I'm wrong, if you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Let's look at some top calls this morning. Some of the analyst upgrades and downgrades. First up, Morgan Stanley downgrades Novo Nordisk to underweight. They see slower weight loss, prescription growth in the U.S., and competitive pressures that driving downside risk. Shares down 2.5%. Wells Fargo, they're downgrading Western Alliance to underweight. They say that the bank won't benefit from interest rate cuts until next year. Shares down almost 1%. Finally, Jefferies, they raised their price target on Alibaba to $230. They point to optimism over the company's cloud and AI business, and shares of Alibaba up 5% after already doubling this year, Matt.
All right. Fascinating group of movers and shakers there. Let's get to Electronic Arts. It's going private in the largest leverage buyout on record. A group of investors are paying $210 a share in cash, valuing the company at $55 billion. Bloomberg Tech co-host Ed Ludlow is not in San Francisco. He visits us here at the desk in New York, and we're so glad to have you here, Ed, because not only do you have a wealth of knowledge on this sector, but you also are personally, you have your own heartfelt stake in EA.
Yeah, this speaks to why we've got the biggest leverage buyout of all time. Like, when I was a kid, I had this deal with my parents that if I gave up 4 weeks of allowance, pocket money for British people, on a Friday night we would go to Game or Woolworths, Laureate Smith, and buy a disc. That business model just doesn't exist anymore. Gamers around the world want something that's largely free to play with in-game mods, right, that you buy. And EA has all this intellectual property that it just doesn't have a footprint in those other worlds, esport, franchising into movie, TV, and film, like some of the other big names out there do. And it's a continuation of something that Saudi Arabia has been doing for years. You guys mentioned about JP Morgan and the debt, and the details are important. But everyone's overlooking that the PIF or PIF already had 10% of this company anyway. They're sticking with gaming.
And we should
time.
point out who's going to take. We're talking about the PIF. We're talking about Silver Lake.
Yes.
Who else is? Who are the buyers? Because when you tell me LBO, I think about management, but that's not what this is.
Yeah, and also, when you think about LBO, you think about an environment or a company that is seeing some kind of financial pressure, like slowing growth, which is absolutely true of EA and the video games industry at large. I would focus very much on the public investment fund side of this story. In this letter that Andrew Wilson, the CEO of EA, sent to staff, and he's continuing as CEO, by the way, he uses the words sports and entertainment a lot. And I think that they basically see the public investment fund and what Saudi Arabia is trying to do more broadly as access to markets that they want to be in, but they are not currently in.
Last time we had a deal that even rivaled the size of an LBO, I was talking to Matt about this, was 2007, a completely different company, a Texas utility company that went on to go bankrupt.
확인 바랍니다.
Maybe it's a sign of the times, but what does it say? That there is so much demand for debt financing when we are talking about concerns about consumers, whether they're still spending money. And again, it's a video game company. It's not necessarily like one of these flashy AI newfangled companies that this is happening for.
Yeah, I mean, the parallel I draw, though it's tenuous link, is like what Musk is doing with XAI and some of the debt financing of GPUs and infrastructure. No one seems worried about that. In fact, like every time we have like these market strategists on Bloomberg Tech, I ask them like, do you guys check out the debt paragraph and like read about it? How worried are you about it? And I don't cover the Fed or this macro stuff, but everyone seems pretty sanguine right now that this is the liquidity for all of these companies is not an issue. Whether they roll some of this debt over to EA, which is currently free cash flow positive, like it's worth checking out in the terminal. Like it's not a terrible business. I find that interesting for sure.
I want to ask you about just in general. We seem for a few years to only care about 7 stocks.
Yeah.
Right? And now that sort of Mag 7 moniker is kind of going out of fashion because you've got so many other big stocks that you and Caroline cover on Bloomberg Tech, you know, Broadcom, Palantir, that are, you know, at least growing at the same pace, if not quicker. So
I don't have the column in front of me, but shout out Ryan Vlastelica on the equities team. That guy's awesome. But what did he call it? The 10 AI of Gen AI? And some of these other ones.
There are some that he maybe made up.
But you know, the point is, right, is that a lot of the Mag 7 names were tied to the first phase of what we saw, massive infrastructure investment, largely related to training of AI. The revenue generation is on software, like people using that work to make more attractive software products, and that's why Palantir is in there. But Broadcom is also muscling in a little bit on NVIDIA's territory, offering custom chips to anyone that will buy them, and that anyone is OpenAI.
It's grade 8, golden dozen, 10 AI of Gen AI, and the takeaway is obviously if it doesn't sound catchy, it could never be a moniker for this market.
But you know, also like, you know, investors are more discerning. Like we've learned this hard lesson over 2 years. Micron is a great example of that. 2 years ago, Matt, we talked about high bandwidth memory, and actually the stock's performance since, like Wall Street was paying attention for sure. And I don't know that Micron's mentioned in any of those groups.
We talk about being discerning, yet Oracle has been on this massive run and getting all this financing for production facilities that it doesn't yet have, and taking out massive amounts of debt. Manny Roman of Pinnacle was on Surveillance earlier basically saying, we don't know what the future is going to look like, and you have to be humble about the errors that you might get going forward. Maybe the closest you can kind of bet on is 6 months ahead. Is this not an investor base that's betting on years and years of spending to come that we don't know if will actually come to fruition?
So when a data center gets built, let's understand who's building it, who's financing it, and who's going to use it. And the only question that we as Bloomberg television anchors, in my opinion, right, should use from this point is who is writing checks that they cannot cash? Is it OpenAI who leases the capacity? Is it the energy industry or the utilities because they don't have the ability to support this? Keep asking that question because you know, in the marketplace, people are starting to ask that, even if they're not worried about the debt portion.
Right, and as we play this sort of stock market shell game, is Huawei catching up to?
Right, Nvidia's up like something % this morning, right? Anyway, in spite of that.
Yeah, in spite of that Huawei story, right now we're looking at Nvidia shares that are gaining 2% and almost 3%. We should say Oracle is up today as well, but it's still trading at like 285. So it hasn't been this low since the beginning of September. It had a rough week. Ed, great having you here. Sure. We could talk for hours, but you're going to do that, at least for 1 hour at 11 o'clock with Caroline Hyde.
They let me.
We look forward to Bloomberg Tech. And we're going to talk when we come back about something that's decidedly non-tech.
Decidedly non-tech.
Unrelated to AI.
Yeah, literally quite physical because it's big boats. Consumers are taking cruises. Carnival says nearly half of 2026 is already booked. We're going to have more on their strong earnings. But why is the stock falling 2 1/3%? That's coming up next on Bloomberg Open Interest.
up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. Just about 20 minutes into the trading session, the S&P 500 trading up 0.4% at 666.9, 66.70 now. The Nasdaq right now up about 0.9%, 24,713. So you can see tech stocks doing considerably better than the rest of the S&P. That as evidenced by NVIDIA, up 2.7%. That's the big mover, and that's a big lift on the tech-heavy indexes. Oracle was up, but now has turned down. It's only 0.3%, but that means if we close in the red, it'll be the fifth session in a row that Oracle trades down. EA, obviously the biggest leveraged buyout ever. Shares at 210 in the buyout, so we have a ways to go to get there. That's lifting Take-Two as well. And then the cruise lines are both down. We're going to talk to the CEO of Norwegian Cruise Lines. Harry Summers is going to join us in just about 30 minutes' time. But Carnival came out and lifted its full-year guidance, and yet, Danny, shares are off 2%.
Shares are off 2%, but it's probably worth emphasizing that they're up 22% year to date. Let's get more on Carnival. We're joined now by Bloomberg Breaking News editor Guillermo Molero. Guillermo, is this just a case of the bar being incredibly high for Carnival?
That bar is definitely very high. I mean, the shares have been ripping all year, like you've been saying, especially since April. But, you know, the company has just raised its guidance for yields, raised its guidance for adjusted net income. They're looking at a really strong finish to the year, especially after a really strong summer season.
They've underperformed, you know, over a longer period of time, Royal Caribbean, and so has Norwegian. What's the play in this cruise industry? Danny was mentioning that higher-end consumers may be looking to get in on the action. So are they buying new boats? Are they upfitting their existing fleet? How are they attracting luxury buyers?
Well, one of the big things that Carnival has done this quarter, at least started offering this quarter, is their new Celebration Key, which is one of those private island offerings. You know, other cruise lines have started to offer these sorts of products that can really differentiate themselves, and I think that's what Carnival is trying to do, is really bring in consumers that are expecting a little bit more, especially from a carrier that might have that broad-based appeal. I think they will also want to try and bring in customers that can spend a little bit more, and they look to, you know, be doing a little bit of that just now.
These undertakings, I'm assuming, are incredibly expensive too. To have an island, have new boats, fit them out, make them a luxury offering. What does it look like the return on some of these investments that Carnival and others have doing? Has it been paying off to have this shift into creating this ecosystem where everyone is forced to just spend money at Carnival and not go ashore somewhere and spend money at an actual restaurant? Yeah, definitely. And I think, like you were saying there, it's about keeping the money in the ecosystem, and I think that eventually will have a really big return for them. The capital expenditures, I think, just for the next quarter look to be about $1 billion. So it's definitely an expensive undertaking, and they're doing a lot of balance sheet reworking to try to make sure that they can, you know, keep the company's balances afloat while they're doing that. But in the long term, I think the goal is to keep all of the money inside so that every aspect of the vacation, the room, the amenities on board, the private island that they'll sail to, and the money that they'll spend there,
everything is going to stay in that Carnival bubble, and eventually, hopefully, that'll drive up returns even more.
All right, Guillermo, great to have you on. Thanks so much for joining us with this story. Carnival Cruise Lines raising its guidance, but the shares falling 2%. We're going to have more on the cruise industry in the next hour. As I've been telling you, Norwegian Cruise Line CEO Harry Sommer is going to join us. He just rang the bell at the New York Stock Exchange. They've got a new boat coming in that we're going to talk about. Apparently, some of these cruise lines have racetracks on board. On Norwegian Bliss, cruise passengers can drive go-karts on a 2-story racetrack. That might be enough to sell me, actually.
I would be terrified. I don't want to drive a race car on top of, like, in the middle of the ocean.
I mean, the more danger, the better, right?
I have a lead foot. What if I just, fully...
But it's water. You'll be okay.
I don't think that's how it
still
works,
could be
but
could be pretty dangerous. Still, check on stocks. We'll talk to Harry about this because I'm sure they're not endangering any customers' lives. Quick check on stocks right now. We are up across the board. Well, no, the Russell 2000 is now in the red. Coming up next hour, other than that, we're going to talk the world of private credit with New Mountain Capital's Laura Holson. My old buddy Tim Draper is going to join us to talk about AI and reality TV. This is Bloomberg Open Interest.
A cidade estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. New details on yesterday's shooting and fire at a Latter-day Saints church in Grand Blanc, Michigan. At least 4 people died. The suspect, a local Marine veteran, was shot and killed by police. CBS's Natalie Brand.
Investigators believe that he used a gasoline type of substance to set that blaze, essentially destroyed the church. There were other improvised explosive devices, not that powerful, but he had put these devices together, investigators believe, and set them at the church.
Officials are still trying to pin down a motive. President Trump will meet with congressional leaders today as a government shutdown looms Wednesday morning. Chief Washington analyst Robert Costa.
When I spoke with President Trump yesterday, it's evident that he's not really that nervous about a government shutdown. Now, usually when you talk to a president of the United States and a shutdown's on the horizon, they are worried. But the president believes he has the power, I'm told, to use executive power to get rid of federal jobs, to cut some federal salaries should there be a shutdown.
Federal troops are headed to Tennessee. WREG TV's Quamitra Wilborn checked out the mayor's website.
This week, the Memphis Safe Task Force will be in full effect as directed by Governor Bill Lee and President Donald Trump. Agents from 13 federal agencies, plus the Tennessee National Guard and 300 additional state troopers will arrive in Memphis to help local law enforcement fight crime.
The state of Oregon is suing the Trump administration after the president ordered 200 guard troops to Portland. The 22-year-old suspect in Charlie Kirk's murder is due in court for a hearing in Provo, Utah today. A judge will decide if there's enough evidence against Tyler Robinson to go forward with a trial. Utah Governor Spencer Cox, a Republican, has been pushing for bipartisan conversations. He tells 60 Minutes.
I've been studying political violence. And so I'm keenly aware when these things happen. And I'm seeing people get murdered, get attacked, who are Democrats and Republicans.
Today's hearing is open to the public. It's a big deal in the gaming business.
Electronic Arts, which makes games like Madden NFL and The Sims, is being acquired for an astounding $55 billion. Under the deal, EA will no longer be a publicly traded company. Saudi Arabia's public investment funds, Silver Lake and Affinity Partners, will share ownership amongst themselves and pay EA stockholders $210 per share. It's the most expensive sale of a public company to be taken private ever. Stacey Lynn, CBS News.
The Dow is down 52 points. This is CBS News. A country music star is backing out of more shows.
Dolly Parton says she's postponing her residency in Las Vegas over her health.
Here you come again.
On social media, the 79-year-old writes, "I am not going to be able to rehearse and put together the show that I want you to see and the show that you deserve to see." She says she has to undergo a few procedures and that December dates will be pushed back until fall next year.
Working 9 to 5.
She missed an event at her Dollywood theme park this month due to kidney stones. She also writes, "Don't worry about me quitting the business because God hasn't said anything about stopping yet."
They never give you credit.
Matt Piper, CBS News.
An original Mary Poppins star appears to be the picture of health. 99-year-old Dick Van Dyke bumped into Rick Springfield at a gym in L.A. The Jesse's Girl singer, 76 now, posted a photo of the two men showing off their muscles. Springfield says the actor got up from the chest press machine and did a little dance before he left. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. Scarlett Fu, Paul Sweeney, this is the Bloomberg Intelligence Program. Coming up, we're going to check in with Ed Ludlow, B-Tech anchor. He's here in New York City. We're going to get him in studio. We'll talk to him about some tech stuff going on out there. Nathan Naidu, a Bloomberg Intelligence tech research analyst. He's going to talk to us about this EA deal going private, $50 billion large. I mean, it's the biggest LBO ever.
Well, yeah, it displaced the TXU buyout in 2007, so shades of bubble behavior?
I don't know. I mean, I got JP Morgan writing a $20 billion check. That's pretty good. Phil Orlando, Chief Equity Market Strategist at Federated Hermes, who'll give us his thoughts on what's going on with these markets. Dan Ives, we're going to talk tech to him, but we're going to lead with Penn State football. They lost yet again to a top 10 team, so it's tough times for Dan. He was out there in State College, I know, for the weekend for that game, so we'll check in. We'll get the latest on all things tech. So I got a lot coming up over the next 2 hours on this Bloomberg Intelligence program. Let's kick it all off with John Tucker and a Bloomberg Business Flash.
All right, guys, happy Monday. This Bloomberg Business Flash brought to you by Van Eck. Van Eck marks its 70th anniversary this year with a legacy defined by forward-thinking strategies, resilience through market cycles, and an enduring commitment to clients. Visit vaneck.com. Well, after Friday's advance, the major stock average is kind of mixed right now. Netflix, let's start there. That's recovering this morning after a post by President Trump with 100% tariffs on films made outside the U.S. Shares of Netflix right now, they're up 0.6%. 6 of the 11 major industry groups in the S&P 500 higher information technology. That's in the lead right now, and that is home to the semiconductor stocks. Western Digital, best performing stock in the S&P 500 after an analyst upgrading their targets for hardware and storage company. President Trump again posting on Truth Social, imposing a 100% tariff on any and all movies made outside of the United States. Meantime, with a government shutdown possibly looming, Lori Calvasina at RBC Capital Markets says if there is a shutdown, it may not matter much to investors.
If you look over time, there have been a number of sizable government shutdowns, but a lot of them just tend to, last like 1 to 3 days. They tend to be pretty short. And when you try to go back and sort of see what the stocks actually did during the periods when the government shut down, I would say, kind of very mixed and very mild is what you tend to see.
And right now, the S&P 500, 30 points higher. That's up just about 0.5%, 66.73 on the index. The Dow Jones Industrial Average, 16 points lower. The NASDAQ 100 up 214 points. That is a rise of 0.9%. Deutsche Lufthansa planning to cut 4,000 jobs by 2030. This will be the steepest reductions at Europe's largest airline group since the pandemic ravaged the airline industry. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Scarlett and Paul.
I remember the Deutsche Lufthansa CEO made some comment during the revenge travel of 2022 about how much fun they were having on an analyst call.
Okay.
Just, raking in the money because everyone was traveling and buying up airplane tickets.
Yeah, exactly. I guess we're now normalized now. We're back to a more normalized environment. All right. All right, let's take a look at some of the stocks on the move. Today, I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Norma Linden. Norma, what are you looking at today?
Well, let's kick things off with a stock that's making history today. So Electronic Arts, that's ticker EA. We have this stock in focus today, up as much as 5.4%. This, of course, is after the historic leverage buyout deal that we're seeing happening here. So Electronic Arts has agreed to sell to a group of private investors. The deal should be about $55 billion. This is the largest leverage buyout that we've seen on record here. So the consortium that they're selling it toward or are Silver Lake Management, a Saudi Arabia public investment fund. They agreed to pay $210 per share in cash for the company. So this does represent a 25% premium to where its shares traded before talks did leak here. So this is really what's been in focus over the past couple of days. If you look at the stock right now, up for its highest level on record. Shares are up about 39% so far year to date.
Yeah, pretty incredible move. And of course, we'll be talking about it more in depth a little bit later on with our own BI analysts. You're also looking at defense stocks.
Yes,
Laura.
you have to keep an eye on defense. I mean, that's an area that I covered super closely on the equities team before taking on this new role. So always going back toward U.S. defense contractors. We're seeing shares of the industry really rising today. If you look at Lockheed Martin, L3 Harris, RTX, these are all pushing higher along with Boeing here. And this is after a report from the Wall Street Journal that the U.S. Department of Defense is pushing missile suppliers to quickly double or even quadruple production rates here. So pretty bullish call here, of course, and you are seeing a broad-based rally here. If you look at S15 Aero, AERO, that's an index that I tend to track when you're looking at aerospace and defense contractors here. And that stock or that index is up right now, also hitting its highest level ever. Lots of green across the screen today.
Yeah, my number one offspring works at Lockheed Martin. Not allowed to talk to me about his job.
He's tight-lipped.
Staying mum.
Yeah, that's what they do over there. So anyway, so what else we got?
Lastly, I want to take a look at Occidental Petroleum. That's ticker OXY here. Also in talks to sell its OxyChem petrochemical unit. The deal is worth at least $10 billion. That's according to a report from the Financial Times this past Sunday. So you are seeing shares of Occidental Petroleum hitting their highest level since April. It's clearly lots of optimism today in the market. But the divestment would be the U.S. company's biggest yet and would create one of the world's largest standalone petrochemical companies.
All right, good stuff, Nora Melinda. Really appreciate it. Nora Melinda with our market drivers today. And of course, for more conversations like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. A lot of news in Techland today, Paul.
Yeah, absolutely. I'm going to start with EA. I mean, I think our next guest is probably a closet gamer. I'm just guessing. Ed Ludlow, Bloomberg Tech co-host, joins us here in our Bloomberg Interactive Broker studio. Ed, that's a big deal in the world of gaming. $55 billion. Wow.
Yeah, biggest leverage buyout in history. You know, that's going to catch all the headlines and all the participants. JP Morgan with the 20 B of debt. There's something that we didn't talk about earlier in earlier programming. Remember that this is not new for Saudi Arabia. 3 years ago, they committed tens of billions of dollars to push really hard into entertainment and video games specifically, and already held 10% of this company.
And they're big on esports, too.
And big on esports. So, I've been telling this story all morning, but if you allow me to, when I was a kid, I would give up 4 or 5 weeks of allowance pocket money, and I would save it up, and on that 5th Friday or 4th Friday, my parents would take me to a store, and I'd buy a disc for my PlayStation.
Yep.
That's not how the industry works anymore, right? People largely stream and they play free games where the money's to be made in-game purchases. And EA has all this intellectual property, sports, Madden, EAFC, previously known as FIFA, but it's struggled to get outside of the domain of the video game. This was Andrew Wilson, the CEO, and he'll continue to be CEO's thesis that, he who controls, or they who controls the IP will win. And you see that with all these other, like Minecraft movie, right? It makes total sense. So there's a continuation of a lot of themes here. I don't cover the Fed. I don't cover broadly credit markets. I don't cover macro. But, is it that shocking that a leverage buyout at this scale is achievable? Probably not.
Does that suggest maybe the gaming business in general, the big growth years may be behind it now? It is something that we're a private equity firm can leverage cash.
And it's not just me not buying discs anymore, right? For nostalgia's sake. Between the 2010s through to present day, growth has slowed. The video games industry is big on an annualized basis, almost double what Hollywood is in the box office.
That's such an important step.
Right, and say it time and time again, but things are changing. And the way that all these CEOs think about it, including Andrew Wilson, by the way, is who is he competing with for eyeballs? Yeah, TikTok. Are you spending your time in front of a console or on your phone, or against spending it on TikTok? So the investors are interesting. Silver Lake, I don't really know what to make of that other than, TikTok. What's going on and their name being around a lot at the moment.
But also Jared Kushner's Affinity Partners, which is backed by some foreign investors in the Middle East, is playing a big part in this too.
And the LPs there might be really interesting. But again, the Saudi Public Investment Fund is really significant here. If we remember, they already held 10% anyway. And in this memo that the EA CEO sent to staff, he used the word sports and used the words entertainment. And this is, having spent a bit of time with him over the summer, I think this is very much like, okay, we know the domains we need to push into. Saudi's already going in that direction. This makes sense. Mm-hmm. The counter argument is this EA executives looking at the writing on the wall that this industry has a pretty slippery future?
Interesting. But it sounds like if they want to get into these, take their intellectual property and take it to different areas, different platforms, different usages, like somebody like the Walt Disney Company has always said that they look at their content as IP, intellectual property.
That's the model.
Yep, that's the model. I mean, it's better to do it as a private company, presumably, than one where we have to report quarterly or maybe semi-annual.
I mean, again, I'm a journalist. I don't have skin in this game, but the sentiment on all the deals I've covered in the last 5 years since I moved to Silicon Valley, so to speak, it's you can do a lot more quickly when you're private.
Away from the headlines, the prying eyes of the media.
Yeah.
All right, let's talk about the chip business.
Sure.
Huawei, the double output of its top AI chip. Is this to compete against NVIDIA?
Well, remember, doubling from very little is still very little. So the story for Huawei in the 910 CSN, which is their flagship accelerator, they do very low volumes. But, the political environment makes it such that they can serve Chinese technology customers who are under pressure from that government to not buy NVIDIA's now permitted chips on the US side. And so, NVIDIA and Jensen Huang in interviews on Bloomberg television for this whole year has been saying Huawei are a lot further ahead on AI chips than we've given them credit for. Their chips perform as well as some of our best chips.
Interesting.
And so this data, citing sources, of course, in the reporting, is really important as it gives some very clear numbers for 2 years of what they plan to ramp up to.
Right, and the Ascend product line overall in 2026 will get up to 1.6 million dies. Is that also a drop in the bucket, or is that a meaningful number?
It's relatively still a drop in the bucket, and the thing that in our reporting is so key is there's an acknowledgement from sources that the Huawei chip is still not as good as NVIDIA's best chip. Mm-hmm. But if you package it in a system and you offer it as cloud computing capacity, which is the whole Huawei strategy, it's an attractive proposition for inference. In other words, running the AI models, not necessarily training them.
Ed, thanks so much for joining us. Appreciate it. Ed Ludlow, Bloomberg Tech co-host. He's based in San Francisco. We got him here in New York this week, the Bloomberg Interactive Broker Studio. So we grab him here in studio to get the latest on all things technology. Coming up, we're going to check in with Nathan Nadeau, Bloomberg Intelligence Technology Research Analyst. We'll get his thoughts on this EA deal and what it might mean for the gaming space going forward. Phil Orlando, Chief Equity Market Strategist and co-head of Client Portfolio Management, Federated Hermes. He's going to join us as well, get the latest call on the markets here. As we kind of get into the 10 o'clock hour, the S&P's up 26 points. The Dow's minus 50. The NASDAQ's up 200. The market has no idea where it's going today. We'll have more coming up. This is Bloomberg Good Morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Right now, the major stock averages, they are mixed. The S&P 500 up 27 points, 66.71 on the index. The Dow Jones Industrial Average is down 27 points. The NASDAQ 100, 214 points higher right now. Gold hitting a record. And so this lifted the U.S. Treasury's holdings of gold to above $8 trillion in value. I'm thinking Fort Knox. Pending home sales among the data for August, jumping to the highest level in 5 months. And then this week, all eyes are going to be on the non-farm payrolls report for further details on how the labor market in the U.S. is holding up. And tomorrow, we're going to get the JOLTS survey. Also, we're keeping an eye on D.C., whether or not the government stays open. There are leveraged buyouts, and then there are leveraged buyouts. This one's a whopper. Electronic Arts, you've been talking about them agreeing to sell a group of private investors, agreeing to pay $210 per share in cash. Most active stock today includes shares of Tilray. This comes after President Trump posted a video that touts medical benefits of hemp-derived CBD for seniors. Tilray brand shares up right now close to 39%.
Gummies. It's all about the gum.
For seniors.
Just saying.
They need to sleep.
Sure.
They need to get to sleep, and sometimes they can't, and the gummies help.
Yep. So you're promoting this
I'm
on
just
air.
saying this is the purpose for it.
Okay. We check the markets and other stuff for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. You know, driving home, coming in the morning, you know, very early in the morning, you know, you have certain drivers who are all over the road for one reason. Going home, all I smell is pot from other cars. It's just like, it's a serious problem.
Yeah,
so
well,
we're gonna make it worse?
just walking around the streets of New York City, all you smell is pot.
Anyway, that's my
All day
commentary
long.
for today.
Same in the 80s.
You're right.
All right, John Tucker, thank you so much. We appreciate that. Scarlet Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Again, the big story on the M&A front, Electronic Arts going public via an LBO. How about that, kids? $55 billion. JP Morgan advising Goldman Sachs on the other side of the deal. JP Morgan writing a $20 billion check to get this deal done. What's it mean for the gaming business? Nathan Naidu joins us here, technology research analyst for Bloomberg Intelligence. He's based in London. Nathan, what's the how's this price tag look for you? How's the valuation here?
The valuation is at a 20 to 30% premium versus the last recorded market cap before this deal was announced. And it seems like, you know, it is a premium deal, but actually, you know, EA has a lot going for it. It is actually launching a new Battlefield game, and there's a strong prospect for this game. And actually, the game is now in pre-release, and even then, it has already smashed all prior records set by the biggest game in that genre. And that genre is first-person shooter, and that game that has dominated that genre is Call of Duty from Microsoft. So Battlefield 6 is looking to be a successful launch. And next year we have FIFA. And obviously we know that EA has the biggest soccer game in the industry, and that's FIFA. What was called FIFA, but now it's called EA Sports FC. And next year FIFA World Cup will be a special one because it will be hosted across 3 cities, including the US. And if people don't know, US is actually the biggest market in terms of revenue for all kinds of sports games. So that's the second thing going for EA that I think it's going to lead to at least 2 rounds of consensus beats on EPS, earnings per share. So I think for EA, this is actually a good deal, and we can talk about the common struggles faced by game publishers and how these deals would make sense for EA as well as the investors in this context.
So yeah, let's do that, because you mentioned a bunch of the titles, and these are very valuable franchises. This is top quality IP, whether it's EA Sports FC, Madden NFL, The Sims, Battlefield. What does ownership by private equity, by private investors, allow EA to do that it can't do as a publicly traded company?
I think it's all down to funds. So publishers, game publishers in general have been facing two struggles. First one is gamers' attention span and playtime are increasingly getting limited. The reason is people are sticking to brands or franchises that they have played for a long time. And in fact, Newzoo published a data saying that 80% of playtime tend to go back to the 60 or so titles, leaving only 8% of playtime for brand new IP. And this is actually in favor of EA because we mentioned those valuable IP. In fact, if we look at global unit sales, EA has has 4 of those top 20 selling IP globally. It has 4 out of the 20. So that is actually a pretty enticing deal thing for companies like private equity because profit generation is key. And what this means is that EA has franchises that can bring in recurring revenue. We talked about EA Sports FC, we talked about Madden MFL, and they actually revived a new franchise, college football. And it was one of the best-selling titles in the US last year. So recurring revenue is key here. And the second struggle that I was going to go into is development cost is really high, especially in the US. So that means that Western publishers actually have a cost disadvantage when compared to Eastern developers. For example, salaries for game engineers in China is more than half the level in California. And personnel cost, game engineers is a huge part of developing a game. So, Tencent actually launched a new game in the same genre as Battlefield 6, and that's Delta Force. It's doing really well. And what that cost disadvantage is stopping EA from is continuously to push out a strong cadence of content to essentially extending the shelf life of any game. And Eastern developers can do that better because of that cost edge.
All right, Nathan, thank you so much for giving us the instant analysis here on this EA deal, largest leverage buyout on record, largest M&A deal this year as well, $55 billion. Nathan Naidu, technology research analyst at Bloomberg Intelligence. Let's talk about what this means for the broader market overall. And for that, I want to bring in Phil Orlando. Phil is chief equity market strategist, also head of client portfolio management at Federated Hermes. Phil, we talk about this being the biggest LBO on record, displacing the $45 billion take private of TXU in 2007. That was right before the financial crisis. Does a deal this size remind you of, that maybe we're in kind of toppy areas that, the market's on the cusp of turning?
Froth is the word I think you're grappling for here.
I didn't want to say it. I'll let you say it.
Look, the reality is the S&P 500 has rallied 38% from the Liberation Day bottom in mid-April to, record highs that we've seen here over the course of the last week or so. We haven't had more than a couple of a percentage point pullback here or there. So certainly you've had a tremendous run. Is the longer-term trend higher? We believe it is, but that doesn't mean that market's not susceptible to a catalyst that could give it a little indigestion, 5 or 10% at some point. Frankly, we would welcome that, given the fact that you've basically gone straight up for 38%. So I guess both things are right. Longer term, stocks up and to the right. Short term, we could be susceptible to a pullback, particularly if, for example, the government shuts down. It's longer than the market expects. We get some disappointing labor market data, disappointing news out of the Fed. Any number of things could happen. So that's sort of the environment as we see it.
The environment right now, though, Phil, as you noted, the economy's pretty strong. We had a nice GDP print, came in real strong. We had retail sales come in pretty strong. It seems like the economy's doing okay out there.
The economy's cranking. I can't remember the last time we saw a third revision on the GDP that was up 0.5 tenths of 1%. Going to 3.8% in the second quarter off of a negative 0.5 in the first quarter is phenomenal. What drove that? Back to school spending, this is the piece that I wrote last week, was up 4.2% versus 2.3% last year. Now, so the consumer is still up there. It's still, doing well. The pushback, the argument is, well, there's this bifurcation. The low end's not doing well. It's the top end that's driving the whole economy. Well, that's been the case for the last 3 years. And the reality is that the top 10% of America drives half of consumer spending, and consumer spending is 70% of GDP. So as long as this wealth effect remains alive and well, largely driven by the fact that stock prices are doing well and the housing market, housing prices are still just off of record highs. The top 10% is going to still feel pretty flush, and that's going to continue to drive consumer spending.
Right. The top 10% is doing very well. The lower income part of the stratum is not doing as well. And we see that with Tricolor and First Brands and their big blowups over the past week. First Brands, of course, filing for bankruptcy protection. How worrisome is this that this could potentially widen out? I don't want to say contagion, but become a bigger problem for borrowers, a bigger something feeding into a weakening economy?
Well, again, this bifurcation is an important theme. And in order for the middle class or the lower class to participate more fully, I think we need to see a rebound in the labor market. And the reality is that the labor market has been in a decline over the last couple of years, and that decline has been accelerating the last 4 or 5 months. We need to see that trough, and we need to see a turn. We're not there yet. So unless and until that happens, you've got to be concerned about the fact that, the savings rate, for example, has more than doubled over the last couple of years, and that's the lower echelons, if you will, I think, tightening their belts, recognizing that they're struggling relative to the top 10%, which right now is doing fine.
So, Phil, you mentioned your strong back to school. Does that bode well for Christmas, the holiday season?
Well, the short answer is yes. Over the last 30 years, there's about a 73% correlation between the strength of back to school, the strength of what we refer to as Marpril, the mashup of March and April for Easter and Passover.
That's a new one.
And Christmas. So Marpril was up 5% this year versus 3% last year. Back to school this year is up 4.2% compared to 2.3% last year. We're thinking that Christmas is going to be pretty solid.
So real quick, earnings, are they going to be solid as well? Because, boy, this market, you could argue, really needs strong earnings.
Earnings, I just took a look at the fact set, look ahead to the third quarter.
Fact set? First two. It's like riding with training wheels.
The first 2 quarters of this year were very good. Second quarter, revenues up 6%, earnings up 12%. The preliminary thinking is that revenues will be up around 6% again for the third quarter. Earnings, the consensus is up 8%. I suspect when the dust settles, that number is going to be double digits. So I think it's going to be the third solid quarter in a row.
It feels like everyone's forgotten about tariffs. I mean, we get headlines daily on potential new tariffs, but investors have kind of moved on.
Well, we studied the tariff impact on the economy, and in the first 3 months of this year, it had a deleterious impact. The drag from tariffs has been declining since April.
Yep.
So while there's a lot of hand-wringing about that negative potential, it hasn't shown up.
Phil Orlando, Chief Equity Market Strategist, Head of Client Portfolio Management of Federated Hermes on these markets. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We're looking at S&P 500 up by 0.5%. Keep it here on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages mixed right now. Actually, they just turned higher, making a liar out of me. Dow Jones Industrial Average up 6 points. S&P 500 is 30 points higher right now, 66.73 on the index. The NASDAQ 100 up 214 points. That's a rise of about 0.9%. You have shares of NVIDIA. This is in terms of the percentage or the index points for the S&P 500. That is the leader right now. They are up 2.8%, and Apple is proving to be the laggard in the index. It is down just over 0.5% right now. The deal of the day, of course, video game maker Electronic Arts. Those shares up close to 5%, agreeing to sell to a group of private investors. So this deal values Electronic Arts, the video game maker, at about $55 billion, the biggest of all leveraged buyouts. Nathan Sheets at Citigroup, meantime, says, we have yet to see the full impact of tariffs on the U.S. economy.
If I had to use a word to describe where we've been so far, it's resilience. However, part of that resilience we've seen is front-loading. The U.S. consumers, U.S. businesses have seen these tariffs coming.
And then this news this morning, the Eisler Capital Multi-Strategy Fund, it is winding down and returning capital to investors with clients unable to withdraw their money while the firm liquidates all its trades. Ed Eisler closing the investment firm, citing weak returns, shrinking assets, and ballooning staffing costs. Let's conclude with shares of Beyond Meat. Right now, down close to 26%, plunging to the lowest on record. The company made an offer to debt holders that's going to raise more than $800 million of debt. Now we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, fantastic. Thank you so much, John Tucker. Big week here for equity investors. We've got, of course, got the jobs report on Friday, and we've got a number of big headlines for those who are bullish on tech to respond to, whether it's Electronic Arts agreeing to this record leveraged buyout, whether it's looking at the latest developments in the chip sector with Huawei doubling the output of top AI chip as NVIDIA seems to struggle in China. Let's get the perspective from the one and only Dan Ives. Dan, of course, is Global Head of Tech Research at Wedbush Securities, and he joins us now from Newark, New Jersey. Dan, great to speak with you. What would you focus on first here? I know that you are super bullish on tech. You see this as 10:30 p.m. in a party that goes on until 4 a.m. What are you focused on here in terms of the headline that kind of backs that thesis up?
Look, I mean, to me, it's really all about demand. I mean, everything we're seeing in terms of supply, they're just continuing to increase because demand right now, the supply for NVIDIA chips still 12-1. So what we're really looking for is like, what are the derivative effects? Second, third, fourth software chips. And look, just like Electronic Arts, you're going to have a lot of deal making across the board, but I believe more that's going to ultimately be on the chip and software sector.
Dan, so we had the NVIDIA deal earlier. We're making $100 billion into OpenAI. What's the conversation you're having with your clients about that part of the business?
Yeah, I mean, Paul, I think on there, like, obviously there were a lot of questions. Like, you know, is this a good thing? Is it a bad thing in terms of, you know, call it partners or suppliers almost getting together? Look, I view it as like for every dollar they spend OpenAI, they're going to get back $12 to $15. And I think this is just more of a build out that we're going to see across tech. It's not going to be the only one, but it speaks to our view. I mean, more money is going to be spent in the next 2 years in the last 10 years combined when it comes to AI and tech build out. And this is just the beginning.
It's just the beginning. And I'm curious, you know, we actually wanted to get you on because we had a story that our Isabel Lee wrote recently about your ETF and how you've got this social media megaphone that allows you to really proselytize to your followers on social media and talk about your big calls. And it's hard to, you know, get attention for your ETF. I mean, there's so many funds out there, yet you've managed to do that and kind of build a name for yourself. And I'm curious in terms of what how quickly that could change too if the market goes the other way. I mean, you've got a loyal social media following, but they could easily get on you if you make the wrong call and not bring you down, but draw attention to it.
Of course. Yeah, and that was a great article by Isabel and Alexander. Look, I mean, to me, everyone knows our philosophy with AI winners. And this was really at the core to have a research and an ETF that enables, no matter where people are in the world, retail or institutional, to ultimately bet on who we view as the 30 winners, the odds AI 30. Look, if that turns, of course, then you see the negative part about it. But the whole reason we did this and launched in June is my view, we're in year 3 of a 10-year build out. And at the end of the day, if we don't pick the winners and ultimately it underperforms, then everything else plays itself out. And I think people that have followed us over the decades recognize like 3 million air miles, right, last 25 years. It's to try to find the winners before others do.
Dan, one of those has been Tesla. I know you recently upped your price target there. It's been several months now since Elon has left Doge and left the government. Where's he spending his time?
Yeah, I mean, look, Paul, me and you and obviously the team have talked about it a lot over the last, specifically 6-9 months. He's wartime CEO now. He's focused on building the physical AI powerhouse. And that, look, the reason we raised price on Tesla, because I continue to view in physical AI, the two best plays are NVIDIA and Tesla, especially in terms of autonomous and robotics. And that's going to be a key part of the value in Tesla. And I don't think that's being recognized today. But as that plays out, that's sort of the golden goose for Musk and Tesla.
So you have some American national champions like NVIDIA, like Tesla, you can argue. I'm also curious how you see chip makers from other countries, TSMC, for instance. According to Howard Lutnick, the Commerce Secretary, Taiwan must help the U.S. to make half of its chips. We're basically telling TSMC to own 50% of our market share. Does that make TSMC a must-own?
Oh yeah, I mean we have viewed it, as one of a must-own, along with our view of AMD, Broadcom. In terms of everything that we see with Intel, whether it's the U.S. government and obviously NVIDIA, this is an AI arms race playing out between the U.S. and China, and I think that for investors, that's a positive. It's very bullish because of the spending that we're going to see. TSMC clearly being one of the winners, and I think.
But does that create an over-dependence on TSMC?
Look, I think there's definitely a dependence on it, but ultimately, others are going to have to innovate to try to get that market share. And guess what? That's a great thing. That's what you want to see. It's all competition. And I think but right now, they are playing in a massive position of strength in terms of TSMC.
Dan, over the weekend, I know you spent some time in State College, Pennsylvania, Happy Valley. What happened?
Still thinking about it. I mean, look, it was almost a comeback for the ages. Obviously, it was a heartbreaker the way that ended. But again, seasons aren't done in September. I think we'll see Oregon again, and I think it will be a different outcome. But look, it's part of college football, right? It's the heartbreakers. But I still think Penn State's there in January.
Is this what you do all weekend? Every weekend in the fall?
He's a huge Penn State guy. Huge Penn State guy. Now, and the challenge is Coach Franklin can't win the big one, and this past weekend didn't do him any help, did it?
Look, I mean, obviously, that's something he has to, you have to now win the big games, and that's obviously something he's taking ownership for. But look, it was a massive comeback. The team showed fight. And again, Big Ten continues to be a battle. We'll be out in UCLA next week. I think, Paul, this is just the beginning. Just wait for Ohio State.
To watch the game?
I'll be in UCLA on Saturday.
Yeah, he goes to every game. He's one of those. He's one of those people. He's not just a bad dresser. He's also a crazy Penn State fan, which we love. Dan Ives, Global Head of Technology Research at Wedbush Securities, giving us his thoughts on big tech. Yeah, he's a big Penn State guy. And it was a big game against Oregon.
Where they go, he goes.
Yeah, where they go, he goes. Perfect. And they're going to be out in UCLA, which is perfect. It's a game they need right now. S&P up 30 points. The Dow unched. NASDAQ up 200 points. That's 0.9%. More coming up. This is Bloomberg. Good morning.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I guess midnight tomorrow, potentially the government could shut down. Is that correct?
Yeah, but we've been here before.
We've been here before.
Many times.
All right, but no matter what happens, I'm blaming our next guest on whatever happens here. Nathan Dean, he's the senior policy analyst, the only reasonable person I know in Washington, D.C. For Bloomberg Intelligence. Nathan, where are we on this whole shutdown thing?
Yeah, so, right now both sides are digging in. Both sides are talking about their points of why the other party should be responsible for a shutdown. Next up is 3 o'clock-ish this afternoon. There's going to be a meeting over at the White House between President Trump, Senator Thune, Senator Schumer, and the House leadership over what to do next. Now, I don't think you're going to see much in the way of positive news coming out of that meeting. I think that meeting is just going to essentially allow both parties to blame each other. But what I'm looking for is tomorrow morning to see what are the statements between Senator Schumer and Senator Thune about the possibility of a shutdown. Now, I was at 40% chance of a shutdown on Friday. I still think a deal is possible, most likely a one-week CR, but I also wouldn't be surprised come Wednesday morning if we come up and do another hit that I was wrong and the government is shut down.
So a one-week CR doesn't buy them a whole lot of time. Is it, the beginning of another 2-week CR after that 1-week CR? Because the issues that they need to discuss are pretty fundamental. The Democrats want to show the White House that they're fighting, want to show their voters, their constituents, that they're fighting the White House on healthcare issues. And these are things like permanently extending the Obamacare tax credit. That's not going to get resolved in 1 week, is it?
No. And I think right now both sides are just trying to figure out who is going to get blamed for the shutdown and the ability to protect themselves politically going into November. Because if you remember, the Republicans offered a 7-week continuing resolution. And generally speaking, the party that offers the clean CR is the one that has the high ground and ultimately doesn't get the blame in this situation. But as you point out, the Democrats need to be seen fighting President Trump here. So I think in the Democratic camp, a 1-week CR allows them to better strategize about what their message is. And potentially there's like an unofficial handshake, if you will, agreement that they'll have a vote on ACA subsidies, these healthcare subsidies that you're talking about. Potentially that's enough to show that the Democrats are fighting. But if you do get a government shutdown, I think it's going to be short-lived, because if we go into this weekend, the Democrats can say that, yes, we did fight President Trump, but then enter the Office of Management and Budget and Director Russ Vought, who has said that he's going to begin operations to lay off wide-scale, wide-scale government workers, and a lot of them are here in Virginia and Maryland. And so I would think that the Virginia and Maryland senators in particularly are going to be interested to make sure that doesn't happen.
All right, so the Republicans control the White House, they control the House, they control Senate. How do they avoid taking the blame if there is a shutdown?
Well, it's because the House has already passed a 7-week continuing resolution. In the eyes of voters, independent voters, and those of you that aren't affiliated with parties, a 7-week continuing resolution essentially just says we're going to keep the government open until November, and then we'll try and figure out a way to finalize these appropriation bills. As you remember, there's 12 appropriation bills that need to be done every fiscal year. Today's the end of the fiscal year, so obviously that's not going to happen. But the party that offers the continuing resolution is the one that says, look, we are here, we're going to keep the government open while we can continue to negotiate. But there are Republicans who are not happy with this strategy. There are some Republicans out there saying, look, we're voting for President Biden's spending levels. We're not doing anything in terms of cutting the government or trying to do in terms of other priorities. So there are Republicans out there that aren't happy with this strategy. I would also note that the House did this to pass it up until November. And what's right after November 20th? Thanksgiving. So then you're going to get into a situation where it's going to be extremely difficult for parties to potentially cause a shutdown right before the Thanksgiving holiday.
So the Republicans have threatened mass firings of federal workers, as you noted, if there is any kind of government shutdown. One of the Democrats' talking points is that the Republicans would do that regardless, that is their agenda with or without a shutdown.
Yeah, absolutely. I mean, that's something that the Democrats have also said is like, look, that's just a threat. Let's see it. Let's see if they actually do it. But Russ Vought has also deemed the individuals that are going to be the ones laying off workers to be essential. He's already put that out in guidance. And a lot of this is going to go to the courts no matter what. So from the Democratic perspective, their approval ratings aren't all that great. It's 30% or give or take. And there is plenty of time to come back before the November 2026 midterms in order to improve your message. This is very similar to how the Tea Party played out in 2012 when there was a shutdown threat. And they had plenty of time to come back and fix their parties, But again, this is all about momentum. And because we have a Virginia governor race in November, there's also a governor race in New Jersey. Those races are somewhat tight. I'm not sure the Democrats want to actually try and tie those two issues together.
30 seconds, Nathan. We got some congressional leaders coming to the White House today. Any reason for optimism there?
I don't think so. I think this is mostly just political messaging. And I think the big thing to keep an eye on is if President Trump signals openness to extending these ACA subsidies. That's not something that many people in his party want, but would offer the Democrats an off-ramp to get to an agreement.
All right, Nathan, thank you so much. Appreciate that. As always, the only reasonable person I know in Washington, D.C. is Nathan Dean. He understands all this stuff going on down there. He makes it easy for us to understand. Nathan Dean, senior policy analyst at Bloomberg Intelligent, worth his weight in gold, that's for sure. Particularly
He makes
during
it make
times.
sense.
He makes it make sense. I don't know why.
And it's
our
so
elected
reasonable.
officials
It's kind of
can't.
like, guys, figure it out.
Why doesn't he go to that meeting today at the White House?
Well, he's far too reasonable
and just
for
work
that.
something out. He could say, guys, just come on, let's get together here. How hard can this be? For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence radio program starts in just moments. With the S&P up 25 points, the Dow minus 28. The NASDAQ leading the way up 170 points. That's about 0.8%. Tom from the Upper East Side writes in for a Bitcoin quote. We're up 3%, $114,000 on your favorite crypto. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All righty, we got coming up hour 2 of the Bloomberg Intelligence program. Scarlett Fu, Paul Sweeney live with you here in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Ethan Bronner, Bloomberg Israel Bureau Chief, is going to join us here, give us the latest on what's happening in the Middle East. Elliot Stein, Bloomberg Intelligence litigation analyst, can talk to us about the Lisa Cook situation. This thing's going to the courts. We'll have to see how that's going to play out.
Was there ever any doubt, Paul?
No. And if I'm the Supreme Court, I'm like, guys, I have a day job. Stop keep sending me every little inconvenience you guys have. We've got stuff to do here. Miami Mike McGlone, he is in New York this week. We're going to get his thoughts on gold. Because guess what? It's up another $70 today. $3,830. Go figure. But he's been a bullish on gold since the first day I met him, like 10 years ago. Basically, his call was buy gold, sell everything else in the commodity complex. And he's been pretty much right here. So we'll get all that coming up. But right now, let's kick this thing off with John Tucker and a Bloomberg Business Flash.
All right, after the gains that we saw on Friday, the major market averages, they're mixed right now. 8 of the 11 major industry groups in the S&P 500, they are higher. Information technology, best performer. And as you mentioned, Paul, oil prices declining. So the worst performing industry group belongs to energy at this point. In NVIDIA is the leader in terms of the index points, contributing right now to the S&P 500. That stock is up right now 2.8%. Did get some data today. Pending sales of U.S. existing homes, used homes, rising in August to the highest level in 5 months, and you can credit falling mortgage rates for that. And also with news of the biggest ever leveraged buyout, you have shares of electronic arts, that is, up right now close to 5%, 4.8% higher. Meantime, Tony DeSpirito at BlackRock says he sees pockets of irrational exuberance in these markets.
The nature of the participants has changed. Fewer fundamental investors, more high-frequency traders, more retail investors. I think that helps fuel maybe some of those pockets.
Right now, the S&P 500, 26 points higher. That's up 0.4%, 6670 on the index. The Dow Jones Industrial Average is down 26 points right now, and the NASDAQ 100 is up 205 points. A couple of stocks I want to finish making some big moves here. Moon Lake Therapeutics, MLTX is the ticker, down 89%. They had some disappointing late-stage clinical trial data. The company's experimental drug to treat a debilitating skin disease. And Bally's Corporation climbing 6.6% after the gamer proposed to build a $4 billion casino in the Bronx.
Sure.
And it looks like that is gaining a lot of traction with some of the local politicians and the community board in the Bronx.
Sure, let's go to the Bronx.
A $4 billion casino in the Bronx.
Well, Steve Cohen, Mets ownership, trying to build one in Queens, so why
in
not?
the parking lot
Sure.
of Citi Field, or around
It's a lot
there.
of casinos in a short amount of time.
Yes.
That's just
Can
my
we handle
takeaway.
it? Well, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Scarlett.
All right. On that note, let's take a look at some other stocks that are on the move today, not necessarily in the biotech space. Scarlett Fu here with Paul Sweeney, and of course, Nora Melinda, Bloomberg Television's market correspondent. And Nora, I know you're beginning with Carnival, which should be positive given that it boosted its profit forecast, but the stock is down.
Wall Street investors being really nitpicky here. I mean, as you mentioned, they did report results that you would expect, people would be positive about as they did beat expectations here. If you look at adjusted EPS, that beat expectations. They also lifted their guidance for the full year in terms of their adjusted net income here. But Stifel is really coming out saying that investors could be, quote unquote, nitpicking the company's lower than expected fourth quarter net yields guidance. So they're really getting into the details, all the dirty details here, trying to figure out something that they feel as though isn't really meeting the high bar that they had going into the report. So you are seeing this as one of the worst performing stocks in the S&P 500 today, ticker CCL. But I mean, if you look at what the street is thinking more broadly, Wall Street has no sell ratings on the stock right now. About 74% of analysts are advising that people buy.
Cruisers. There's nothing you can do to keep those people on the sidelines.
You
They
can't knock
like
them off.
to cruise. Good for them. All right, what else you got?
Also looking at shares of CSX, this one, though, in the green, up as much as 4.1%. This one also has no sell ratings here, up for its biggest intraday gain since July in this year. And this is after the company named Steve Angel as its new CEO. This, of course, comes after the abrupt departure that we saw from Joe Hinrichs. This really overhauled the railroad's leadership, especially as it's thinking about the pressures that we have from peers, Norfolk Southern and Union Pacific. If you think back, just a couple months ago, they actually came for a deal here that would create the first transcontinental railroad in the U.S. Bloomberg did report back in July that CSX is working with Goldman Sachs to explore options for a deal of its own.
So I emailed Lee Klasko, our analyst, railroad analyst for Bloomberg Intelligence, and I said, hey, was this a surprise, this change in leadership? His response, yes.
Yeah.
Thanks, Lee, for the expansive research there. Now I understand that he's on vacation this week, so that explains it. But at least you got
That's why
back
he's
to
like,
me.
yes, don't bother me anymore,
Yes,
Paul.
exactly.
All right, Nora, we're going to bother you for one more mover. That is DoorDash.
Food here, okay? Ticker Dash, D-A-S-H here. We're seeing shares of DoorDash rising. Of course, this is after it's expanding its relationship with the grocery store chain operator Kroger. So we are seeing Kroger just up a touch here. But essentially, we're looking at Instacart, of course, in focus. That is a competitor here to DoorDash. But I mean, Kroger should be launching almost 2,700 of its stores on the DoorDash platform starting October 1st. So just around the corner here. And you are seeing shares popping off of this news.
All right, very good. Norma Linda, thank you so much. We appreciate that. For more conversations like this, you can subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Bloomberg News out with some reporting by the one Ethan Bronner. He's our bureau chief over there in Israel. Ethan reports that Israel Prime Minister Benjamin Netanyahu is set to hold a crucial White House meeting with U.S. President Donald Trump on Monday amid assertions from Washington that an ambitious plan to end the war in Gaza is nearly complete. Hopefully that is the case, but who knows? Ethan Bronner does join us here. Ethan, what do we know about this meeting between Mr. Netanyahu and Mr. Trump?
Well, as you say, we know it's very, very significant, probably certainly the most significant of the four meetings the two will have held after today. The president met with Arab leaders on the side of the UN last week and presented a 21-point plan, which includes ending the war, and includes bringing in all kinds of aid into Gaza and ending Hamas's role in Gaza. So I think, and of course, the release of the 48 hostages, the 20 living and the 38 who are dead. So that's the broad plan. Hamas says it hasn't seen it and it can't react to it till it's seen it, and we don't know because they were redoing the details even last night in New York. But it looks like the fact that they've announced a press conference afterwards suggests that the Prime Minister and the President have enough confidence that they're planning to say something quite positive about what the President is suggesting.
Or are they moving forward with announcing something that is not completely checked off by all the stakeholders?
Well, that's for sure. I think it's clearly going to be a very vague set of principles. And for example, this idea of Israeli withdrawal, a military withdrawal from Gaza, it will not, as I understand it, have any time frame on it. And you know, the question of where Israel will station its troops, what kind of border there'll be, what does it mean to disarm Hamas, all of those things are going to be, I think, presented in broad terms of principles. And therefore, it'll be possible for everyone to say yes, and then we're going to see how difficult it's going to be to implement it. But I mean, I will say that, you know, Israel has been pounding the hell out of Gaza City over the last few days, and a lot of what the Israeli military thinks it can get done by destroying the military infrastructure in Gaza City will help Israel say that we think we can declare victory and move on. We'll see.
Ethan, President Netanyahu, he has really not given much deference to the Trump administration or the Biden administration, for that matter. Seems to be kind of, to a certain extent, ignoring the wishes of the U.S. government. Is there any reason to believe that President Trump may have some influence during this meeting?
Look, I mean, I think it's very important to Prime Minister Netanyahu to be in the good graces of this administration. I mean, you're right in what you say. There are plenty of red lines from the Israeli perspective about what they're willing to be told and so forth from the Americans. But I think at this stage in particular, after we see all of these countries recognizing a state of Palestine and Israel being threatened to be thrown out of the Football Association, out of the Eurovision, there is a growing sense, and it's also been now 2 years of warfare, so that we may be getting to a place where Israel is looking at wrapping this thing up and looking at a diplomatic solution for the region. I can't promise that, and I do think that the Prime Minister faces a lot of pressure from the right of his coalition. The government could conceivably fall apart. All kinds of things could happen. But yes, I do think that Trump and his son-in-law and Tony Blair and Steve Witkoff do have influence over this government, and we'll see what's happening.
All right, Ethan, thank you so much. Ethan Bronner is Bloomberg News' Israel bureau chief. And of course, just to recap, the President, Trump, and the Prime Minister of Israel, Benjamin Netanyahu, will be meeting at 11:35 a.m. Washington time and hold a press conference at 1:15 p.m. All right, let's move on here and talk a little bit about the Federal Reserve. Elliot Stein, Bloomberg Intelligence litigation analyst, is here with us now. What is the latest with Lisa Cook, the Federal Reserve governor, who is currently still able to serve, but of course the Supreme Court could come out with a ruling at any moment now?
Yeah, that's exactly right, Scarlett. The case is pending before the Supreme Court right now on an emergency application from the Trump administration because the lower courts ruled in Lisa Cook's favor, allowing her to continue to serve, as you said, while her case plays out. The government has asked the Supreme Court to undo that and to remove her while the litigation plays out. So we expect the ruling could come at any time in the next days or weeks.
Doesn't the Supreme Court have a day job? Like, don't they have a docket that they've decided which cases they're going to look at? Yet, it seemingly on a weekly basis, something from the Trump administration bubbles up to the Supreme Court. Don't they have the ability to say, hey, guys, we're busy. Take care of your own business?
Well, I mean, what you're referring to is what's called the shadow docket, which is these emergency applications that come to the Supreme Court. And I think it underscores sort of the just how quickly the Trump administration has been moving on a lot of things, issuing so many executive orders, more than any other administration. And as a result, a lot of those get challenged. And because things have to get unwound on an emergency basis, you know, according to the challengers, that's why so many of these cases get placed on the shadow docket, because they are of an emergency nature.
Right. Well, there is an urgency here when it comes to Lisa Cook and her status on the Federal Reserve. Her attorneys have urged the Supreme Court to let her stay on the job, warning that even a temporary removal risks chaos and disruption in financial markets. Is that something that's going to factor into the Supreme Court justices' ruling or thinking about this?
Well, it's interesting because you know, I put out a note last week saying that I think Lisa Cook already won round one, because Justice Roberts could have issued an emergency stay, meaning he could have put the lower court's rulings on hold immediately, as he has done with other cases where commissioners of other agencies have been terminated and challenged their terminations. He didn't do that here, which in my mind suggests he thinks, you know, maybe this can wait a little, because he referred it to the other justices. And it's also notable that the Trump administration didn't rush to the Supreme Court as soon as the D.C. Circuit ruled in Lisa Cook's favor. They could have gone to the Supreme Court the night before the September 16th Federal Reserve FOMC meeting. They didn't do that, and Lisa Cook has pointed to that as well in support of her argument that this doesn't have to be rushed.
How is the Supreme Court ruling these days? Are they ruling along party lines? Is there evidence that they are in fact neutral, indifferent? Do we have any? What's the
주문 청산이
evidence
완료되었습니다.
to us?
Yeah, I think it depends on the issue. In a lot of the cases where these agency commissioners have been terminated, you do see the rulings really falling along ideological lines, with Democrats supporting independent agencies and saying that the president can't just fire these commissioners at will, and that the for-cause removal has to mean something. The Supreme Court, for the most part, has ruled against that argument and said that the for-cause removal restriction is unconstitutional because these agencies fall under the executive branch. With the Federal Reserve, we sort of see that not exactly happening, and we saw that in the May 2025 Supreme Court ruling, which sort of distinguished the Fed from these other agencies. So I think with this Federal Reserve ruling that we expect from the Supreme Court, it's not going to fall exactly along ideological lines.
So whose commentary would you be listening for, would you be watching for when the Supreme Court does rule on Lisa Cook?
So it's interesting because you're not going to get oral argument in this case. Part of the problem, critics would say, with the shadow docket is, you know, you don't get the fulsome written arguments, you don't get an oral argument, you don't really get to expand on all the issues in the case. So we're not going to have the luxury of an oral argument like we usually do, where you can maybe see where some of the justices are leaning. When they issued the opinion, you may not even know which justices subscribe to which parts of the opinion. So it's a little, you know, that's the criticism
Everything's
of this.
abbreviated.
Exactly, and that's the problem, critics would say, with the shadow docket.
So, I mean, critics just looking at this case would say this is purely political. This is a president going after someone who he does not favor over a nitpick type thing from years and years ago. Can't the Supreme Court see that as well and say, hey guys, this isn't a business we're in, playing your political games?
Well, they will stick, I think, to the legal arguments. Those political arguments do come up in some of the friend of the court amicus briefs that get filed with the Supreme Court, you know, arguing one way or the other. And that can give the Supreme Court some context as to why some of the issues are important, although they already know that, I'm sure. But for the most part, they'll stick to the legal arguments.
Yeah, I believe the former Federal Reserve chiefs, as well as former Treasury secretaries, all those who are still living, except Steve Mnuchin, signed a Friends of the Amicus brief to the Supreme Court urging for an independent Fed. Will that have any sway? I mean, the Supreme Court doesn't need to act on that at all, right?
Right. They'll read those, and those will inform the justice's opinion. And sometimes they'll cite to those amicus briefs. But for the most part, again, they'll stick to the legal arguments. But those amicus briefs from, you know, former Federal Reserve governors and Treasury secretaries on both sides of the aisle really underscores why the Federal Reserve is different from these other agencies, which I think the Supreme Court has already recognized.
All right, Elliot, your Stanford Cardinal actually won a football game last week, beating San Jose State University 30-29. Second win for the Cardinals. They tried to turn that thing around. Elliot Stein, Bloomberg Intelligence litigation analyst. He he veered. He should have gone to business school. He went to law school, and here you go. So
well, we're better for it.
Yeah, I guess we're better for it. But anyway, Elliot, we appreciate getting a few minutes of your time here. Got the S&P up 16 points, down minus 80, and the Nasdaq up 123 points. That's a 0.5%. The VIX sitting right at 16. This is Bloomberg. Good morning.